Good morning. Good morning, everybody. Thank you for joining us at the FSM ETFestival. Thank you. So my name is JP from the FSM1 team, and this year at FSM ETFestival, we are having it here at the projector. So it's the first time we're having it in actually a cinema hall. So it's a very unique experience. I was thinking that it will give me a bit of a creative freedom to be slightly more creative, and that means a bit more lame. So bear with me in the next few slides. But I was also looking back at the history of this event, FSM ETFestival. So we're into our 5th year. We started in 2019 with the first event. And back then, we had a few aspirations as to what we wanted to achieve, what we hope our investors could achieve with the ETFs. So here we start on the lame part. So we're talking about movies, right? Here. So not that long time ago, in a galaxy not that far away as well, what happened was a team of us at FSM1, we were thinking about ETFs, we were dreaming about ETFs, how to be a leading ETF educator to our investors. So I think just now you did a poll, and I think the first important point for many of you is the ability to power up your diversification, because ETFs, they are diversified, and it makes it easy for you to have access to many core markets like your US, your Asia ex-Japan, your Europe, and so on, but also a lot of tactical ideas, because tactical ideas, you may not be able to find it so easily in other investments. But for ETFs, you can have a lot of very interesting, very rare ideas, which I'll talk more about later, because I have a couple of slides on what our clients have been buying into. Of course, ETFs are affordable as well, so you can start from a small amount. That was our dream. We wanted to make it very easy for our clients to be able to start investing. So here I just mentioned the fact that as we progress over the last 5 years, one of the newer features a few years back was to introduce the ETF regular savings plans for investors. And with that, we're the only one in the marketplace that can allow you to invest from $50 in the RSP at 0% processing fees. More on that later. So the first ETFestival in 2019, it was at the Capitol Theatre. Any of you were there that day? Yes? Yes, a few hands. Thank you. So 5 years of relationships over ETFs. So that was back then. And even during the COVID years, when we couldn't have the physical events, we were still doing ETFestival, but we were doing it online. So 5 years later, today, our goals for our clients, our dream that I shared about just now, hasn't changed. We still want ETFs to be a very easy way for you to build your portfolio, and of course to hopefully make more money in the longer term. Today, the one change is a lot more ETFs are available on FSM1 for you to trade into. So back then when we started, lesser exchanges, but today a lot more. So the number of ETFs you can have access to is actually larger. It's over 3,500. But more is not always a good thing. 3,005 is a huge number of choices. So our goal is also to, of course, help you narrow down and zero in on the ETFs that are interesting. So that's what we will do later. My colleague Polun will run through the new ETF focus list. So I think our clients have also embraced ETFs into their portfolios because, FSM1, we started as a unit trust supermarket. But in the last few years, we've added ETFs, bonds, and so on. So it's a few products under one roof. But ETFs has also become more popular with many of you. And I have this slide to share with you. So some of the more popular sectors this year, not showing this so that you also go and follow. It's not about fear of missing out here, no FOMO here. It's just to tell you that these are some of the popular ideas that our clients have been looking into this year in 2023. So if you look at this, it kind of maybe also tells you about, of course, our clients' mood and expectations. Are they in the mood to invest more in equities and so on, or bonds? There's a mixture, but mostly equities. And if you look at the list, Chinese tech last year was a horrible year, right? But I think some of our clients have been wanting to maybe take a bit of a position, maybe either to lower their average cost or to just make some, money now that the prices are lower. STI is very popular. The Straits Times, our home market, is still very popular with many of our investors. I guess a lot of our clients see it as maybe a starting point for their portfolio, and also maybe as a dividend play. You'll be hearing from our partners on this topic later today. REITs, for many Singaporean investors, a perennial favorite. And I think gold was doing quite well because markets have been terribly volatile. So I think gold tends to be a hedge in many investors' mind. So that has been popular. Semiconductors is one of the views that our research team has. My colleague Terchun will be telling you why it's a sector that he likes a lot. And of course, ETFs is also quite interesting because they are the leverage or the inverse ETFs, but those are risky ones. Of course, not all our clients will have the appetite for those kind because you're taking inverse position because an opposite view lah. So if you expect, for example, oil sector to come down, then you buy the bear ETF. So that also has been quite popular with some of our clients, but of course at much higher risk. I need to add that point. So what are the ingredients for success we hope that can help you to build a strong ETF portfolio? So those are the 3 points I'll be running through very quickly. So ETF focus list, the regular savings plan, as well as the various tools and resources we have on our website and mobile application. The focus list. So this year, the focus list, we renew it every year. This year, there are more ETFs for you to look into. There are 53 of them as a starting point for you. We always talk about core equity and tactical ideas. Tactical ideas, usually our research team will tell you, put them as part of your supplementary. So core, it's basically the foundation of your portfolio and it's a backbone. So for example, some of you may want to have 80% of your portfolio in the various core equity or maybe even fixed income ideas. And for tactical, it's part of your smaller supplementary portfolio. So keep it to a smaller part of your portfolio because these are your riskier bets. And, as a result, they can go up or down quite fast. So keep it smaller. So it's a bit like a football team formation. You want all your exciting strikers to just form a smaller part. You don't want all your whole team to be going upfield to try to score a goal. You want your goalkeeper defense to be steady. So that's your core. Second point, the regular savings plan. So the idea behind regular savings plans, for those of you who may not be too familiar, it's really the core idea that small investments add up over time to have a big impact. So it's something that I myself personally do. It has a lot of advantages. Compounding is one. Second, when markets are down, a lot of us may not be in the mood to invest, right? Which is the theme of our ETFestival, in the mood for ETFs. So no mood to invest, then we stop investing. And I think that could be a mistake sometimes because when markets are down, well, the cost of the investment is lower. So if you have a regular savings plan, it still forces you to still invest. So it's something we like. We think it's a strategy that benefits our clients tremendously. So it's something that we put some efforts to make it more interesting for you. So one of the change is today, compared to a few years back, there are now over 100 ETFs in the ETF RSP list that you can choose from and build your investment portfolio. And like I said, easy starting point, just from $50 upwards, you can start to invest into a RSP. And we make it also easier by having a 0% processing fee on the ETF regular savings plan. So a lot of savings, yes, and a lot of selling points I wanted to say. So you can have the QR code here to scan and read more about this article. So talking about ETF regular savings plan. So just now I was talking about what our clients have been buying, year to date. But how about regular savings plan? So actually, a lot of you who have ETF regular savings plans on FSM1, these are the ETFs that you like. So S&P, not a big surprise. STI, like I said, is there. I think for a lot of investors who just want to get started and have exposure to the whole world, then the global stock index makes a lot of sense. REITs, because of the income play, although the outlook has been a little bit more challenging, especially in the last 1 year when interest rates go up, then the REITs has also suffered a little bit. But it's usually very popular with our clients. China Tech, for a long time, our clients also like that, and even for us previously, of course now a lot less so. Semicon and healthcare. Healthcare is also a sector that has been quite popular. So in terms of the third point, in terms of how we want to help you make it more interesting, make it easier to invest, those are the various ideas. So insights, these are written by our research analysts. You'll be hearing from them the whole morning. So they write something talking about some of the ETF trends they see in the market. Maybe there are new ETFs in the marketplace. Are they interesting? Is it worth your time to look into? They write about it. They also do Q&A with our fund managers and ETF partners just to introduce some of the newer ETFs in the market. And of course, they also write their own research articles with their own calls as to whether this ETF or this market is interesting or not. And so those are the various things that our research team does. The tools on our website, you have the ETF selector, so you can choose a few ETFs based on the sectors that you like. Then you can see their performances. You can also chart them into the chart center across different products, so you can see which one performs better and so on as you compare. And of course, in the last 1.5 years, we have also launched the iFast TV channel. So you can download iFast TV app, or you can watch those TV videos on FSM1 website as well. So those are all the interviews with our analysts, with our fund houses and ETF partners, talking about ETFs and the macro outlook and so on. So that is another educational tool that we have added in the last 1+ year. So with that, with a lot of the resources, we hope that we can help investors around the world invest globally and profitably. You'll hear a lot more about the outlook for the markets, the different products from my colleagues in iFast research team and our partners. Happy to catch you later as well, especially the last segment of the day in the panel discussion. So with that, thank you very much for your time. Enjoy the day. Good luck for the lucky draws.
Good morning, everyone. So my name is Bolden, a research analyst from iFast. And today we'll be sharing more about the ETF focus list. Right, so more about ETF focus list, which contains the best-in-class ETFs, and it will be served as the starting point for your investment journey. So here's the outline of the presentation today. I'll start off by giving a brief overview of what are ETFs, before moving on to share about how to go about selecting the right ETFs for yourselves. Last but not least, I'll be sharing snippets of our ETF focus list for 2023, which can guide you through your investment journey. So without further ado, let us begin with a brief overview of what are ETFs. So an ETF is a basket of securities that tracks an underlying index, providing investors with an access to a portfolio of stocks, bonds, commodities, or even currencies. So most ETFs today are passively managed to produce a return to replicate its underlying index. And the underlying index can be a market index like the STI or the S&P 500, or even an index for a specific sector or industry like the Hang Seng Tech Index, which tracks a basket of Chinese technology stocks. So there are various types of ETFs that allow investors like you and I to reach every corner of the market. And the most common type of ETFs will be equity ETFs, which generally track a particular equity market or a specific industry. Of course, there are also fixed income ETFs, which track a corporate bond market or a government bond market. So ETFs can provide exposure to alternative assets as well that can serve as a hedge to your portfolio, such as commodities and currencies. So given that there are so many ETFs today from various exchanges, choosing the right ETF might be a daunting task. And given that not all ETFs are made equal, I would like to share with you a few factors to consider when selecting an ETF. And this is also the methodology that we use to select the ETFs for our ETFs focus list. So when choosing an ETF, we look at both quantitative and qualitative factors. Under the quantitative factors, we consider the expense ratio, the liquidity, as well as the tracking difference. So first, for expense ratio, this is usually the general annual cost that investors have to pay in order to cover the ETF's operating costs and management fees. And this is why we prefer ETFs that have a low expense ratio. Assuming all else is equal, the lower the cost, the higher the returns. Secondly, a factor to consider is liquidity. So which refers to how easy it is to buy or sell an ETF. We prefer ETFs that are more liquid, which means that they should have higher average daily volume as well as tighter bid-ask spreads. Lastly, we also consider the tracking difference, which is the difference between the ETF's performance and the performance of its underlying index. All ETFs will have a tracking difference, which usually arises due to factors like expense ratio, rebalancing costs, currency hedging costs, securities lending, and so forth. Having a smaller beta spread and tracking difference will also be more desirable, as this means that the ETF's performance generally have a better tracking of the ETF and security itself. So after considering the quantitative factors, we'll move on to the qualitative factors, which are the choice of the ETF as well as the structure of the ETF. So first off, it is important to consider the choice of index. The underlying index must be a good representation of the market and sector that the ETF is intended to track. For example, if you want to access to Chinese technology stocks, the Hang Seng Tech Index will be actually more relevant than, say, just the general Hang Seng Index. And one way to gauge the underlying exposure is to look at the investment objective, as well as the top 10 holdings of the ETF itself. So next, under qualitative factors, we also consider the structure of the ETF, as ETFs can either be physical or synthetic. Of course, the majority of ETFs are physical, which means that they hold the actual underlying securities that make up the index. However, there are also synthetic ETFs, which rely on derivatives, such as swaps, to execute its investment strategy. This allows investors to gain exposure to illiquid and hard-to-access markets. Okay, so this sums up the factors that we consider in our ETF selection methodology. And with this, I hope that I've given you a better idea about how to go about selecting ETFs. And we have reached the highlight of the presentation, which is the latest edition of our ETF focus list. So, as mentioned by JP, to help guide investors on our investment journey, we first introduced our ETF focus list in 2018, whereby we have seen through thousands of ETFs, which has only increased over the years, and then identify the best-in-class ETFs. To ensure that our recommendations remain relevant and up-to-date, we refresh this on an annual basis. So I'll start off with some of the core equity holdings. So firstly, we've made changes to the China A-share recommendation. As a house, if you read our articles and our online media articles, although we've maintained a negative view on Chinese equities ever since late 2022, we are positive on the onshore Chinese A-shares. So Chinese A-shares refers to stocks listed on either the Shanghai or Shenzhen Stock Exchange. And one of the most commonly used benchmarks or indices would be the CSI 300 index, which tracks the top 300 companies traded on the Shanghai and Shenzhen Stock Exchange. So as China moves towards a top-down state-controlled economy, it is now more important than ever to align the portfolios with Chinese priorities. And that means investing more in SOEs and companies that operate in favored industries such as green energy, electric vehicles, semiconductors, advanced manufacturing, and automation. And it's worth noting that the Asian market should continue to enjoy policy support given President Xi's desire to develop a robust onshore capital market to boost tech fundraising. And given that most of the companies found in the Asian market are found in the CSI 300, we believe that the onshore market might perform better than the offshore market. So in the last year, we recommended the iShares Core CSI 300 ETF. So this year, the reason why we have decided to recommend an onshore listed ETF, the eFund CSI 300 ETF, is because it has a lower expense ratio, larger AUM and liquidity. And we generally think it's more liquid and a better holding. So, I mean, for investors who have already been investing in the iShares Core CSI 300 ETF for their regular savings plan, or simply just preferred an ETF not listed in the Chinese exchanges, it is still a good option as it tracks the CSI 300 index and has a huge AUM and liquidity. So next, we made a change to our recommended ETF for the digital economy under core equity. So I know, as you have all known, despite the poor performance last year in 2022, investors continue to love technology stocks as they are often associated with growth and capital appreciation. So although growth and technology stocks are likely to meet challenges ahead in the near term, it is difficult to deny their growing importance in the world that we live in today. Therefore, we believe that the digital economy still remains an important piece of the global economy as well as investors' portfolios. So across the longer term horizon, we remain optimistic on tech stocks, especially the larger and more profitable names, which are better positioned to weather the upcoming storm. Therefore, we recommend the Invesco Nasdaq Internet ETF, PNQI, which has a majority of its allocation to the big tech companies. So last year, our recommended ETF was the ALPS All Shares Global Internet ETF. Now, the reason we made this change was because the Invesco Nasdaq Internet ETF has a larger allocation to the big tech companies. And we believe this will be better to weather the storm in the near term as well as the longer term. Although the Invesco Nasdaq ETF has a high expense ratio at 0.6%, it makes up most of the differences by having a larger liquidity as well as AUM. So as well, for the US quality, we also added another two subcategories, the US quality and US value into core equity holding. So high quality companies generally tend to experience smaller earnings decline relative to other companies, especially during tough times or the upcoming recession. Furthermore, they also have a proven track record of having a lower maximum drawdown even during recessions. And sectors found in the US value composition have remained resilient in earnings throughout history and throughout the past few recessions as compared to the growth and longer duration names like the growth stocks. So we believe that higher for longer inflation and interest rates are pushing the US economy to the brink of a recession. And these are times where exposure to high quality and value companies may be beneficial to investors' portfolios. So for the US quality, we recommend the JP Morgan US Quality Factor ETF, ticker symbol JQUA. And for the US value sector, we recommend the Vanguard Value ETF, ticker symbol VTV. Next, we're done with the core equity changes. Next, we move on to the fixed income category, where we have removed the subcategory China property bonds. So the reason for this is because we have taken a more defensive stance on high-yield bonds issued by Chinese property developers. Moving forward, the property sector's role in driving China's economy is expected to diminish, coupled with weak liquidity profiles and authorities' tough stance on the sector. We believe that there may be substantial risk involved in investing in an ETF that is focused solely on China property bonds. Now, investors who still wish to gain exposure to the bonds may opt for a more diversified instrument, such as our instrument, the iShares Barclays Capital USD Asia High Yield Bond Index ETF. Next, under regional equity, given the delisting of our recommended ETF, the Spider FTSE Greater China ETF, and the lack of viable ETFs on our platform, we have decided to remove the Greater China subcategory altogether. And for investors who are still keen in this region, can head over to our recommended fund list, which will also be going through a refresh later this year. Next, we have decided to revamp the commodity category, as we felt that more could be done to make it more comprehensive and representative of this space. In order to provide a more holistic view of the commodity category, we have moved agribusiness and metals from the tactical plays category. Through the recommended ETFs for these respective subcategories remain the same. And for the energy subcategory, instead of an ETF that tracks oil futures, we have chosen the Energy Select Sector Spider Fund, that tracks the major oil companies. Lastly, in order to provide investors with a more comprehensive ETF that spans the overall commodity space, we added a category called the Global Resources, where we recommend the Spider S&P Global Natural Resources ETF. Besides the changes already mentioned above, we have also made notable changes to the tactical plays category. Firstly, we have removed China banks and China real estate from the tactical plays category. At present, this category is crowded with China sectorial ETFs. And in line with the removal of China property bonds, we have also opted to remove this ETF. We believe that in the long term, the profitability of private developers is expected to be threatened with China's shift to a top-down state-controlled economy. Next, to condense and streamline the exposure to the US technology sector, we have removed US Internet and US Tech, as there are some overlaps with the digital economy subcategory under core equity. So for investors who still like exposure to the US technology space, they can take a look at the digital economy ETF under core equity. And beside these removals, we continue to make new additions as well as changes to our list under this category, as we foresee strong circular drivers for the following thematic sectors. Firstly, for China electric vehicles. Continuing on last year's inclusion of this subcategory, we continue to believe the Chinese electric vehicle market will be supported by government policies and propelled forward by supply chain integration as well as manufacturing proficiency. This year, we have changed the recommended ETF to the Global X China Electric Vehicle ETF, given its larger assets under management, higher liquidity, as well as lower expense ratio. Now, this ETF also consists of only A shares, which is more likely to outperform shares listed on the offshore markets. Next, for Chinese semiconductors, with a similar reasoning to the change we made to the China A share subcategory, we have opted for an onshore listed ETF, as it is most cost efficient for investors. Furthermore, as mentioned above, this ETF also consists of only A shares, which is in line with the view that onshore listed ETFs likely perform better. So investors who are keen to invest in this sector can do so using the Guotai Semiconductor Industry ETF. Next, for China Tech, we've adopted an onshore listed ETF this year, similar to reasons above. And this year, instead of using an ETF that tracks the Hang Seng Tech Index, we have selected the ETF that tracks the Chinex Index, which provides investors exposure to onshore listed China A-share technology companies. Investors who are keen to invest in this sector can do so via the GF or Guangfa Chinex ETF, listed on the Shenzhen Exchange. And last but not least, I will touch on US consumer staples. So this is a new addition to our subcategory, technical place category. We believe that with elevated inflation and rising recession risk, we recommend investors to adopt a more defensive stance. So goods from the consumer staples category should continue to enjoy steady demand even during a recession, or even during emergencies as we have seen, such as the recent COVID-19 pandemic. Investors who are keen to invest in this sector can do so via the Consumer Staples Select Sector ETF, ticker symbol XLP. So to view the full list of ETFs in our ETF focus list, please visit our FSM1 homepage. Then go on to the ETFs or Research tab and click on the ETF focus list as shown on the slides. You will then arrive at this page, and to navigate, simply switch between the 6 different categories that we offer as shown here. And that is all. All in all, our ETF focus list serves as a good starting point for investors who are seeking diversified exposure to markets at a low cost. And you may notice that there are some changes in ETFs as compared to last year. They have not made the cut into this year's focus list. And if you're still holding on to them, do not worry, as there are still viable investment options for your portfolio. These ETFs will continue to be available under the regular savings plan. And with this, I've come to the end of my presentation. Thank you all so much for your time.
Hi, good morning, everyone, and thank you so much for joining us here at our ETFestival 2023. My name is Wei Ren. I'm part of the research team at iFast, and today the key focus of my sharing. Sorry, can I also have the notes on my screen? Thank you. The focus of my sharing today is on the outlook for the rest of the year, and also suggestions and how you can potentially position your portfolios for a challenging year ahead. So I'd like to just start off my sharing today with a quick recap of what has happened so far in equity markets. So I think equity markets have so far delivered quite good performance in 2023. So if you look at this particular chart that I have over here, so if you look at the performance of global equities, Okay, despite all that drama that has happened in 2023, global equities are still up by 8.6% in the first 4 months of this year. And also, if you look at other developed markets like Japan, US, and Europe, all of them have delivered very good performance this year. And then you have the obvious outperformer on the far left corner, which is your tech companies. NASDAQ has been on a bull run in the first 4 months of this year, and it has clocked up quite a remarkable gain of more than 20% so far in 2023. So I think all in all, it has been quite a good performance for equity markets. But underneath this good performance, it's also a year that has so far been characterized by rising market volatility and also quite a drama-filled 2023 because inflation at this point, it still remains persistently stubborn. Despite the Fed's most aggressive rate hike campaign in almost 40 years. Economic growth is also slowing, and we also have seen a series of bank failures this year, not just in the US, but also over in Europe. Credit Suisse has collapsed as well. So despite all this, I think equity markets in general has had delivered quite a good performance. And then there is China. So if you look at where China is on this table, on a year-to-date basis, China is actually down by 1.1%. So I think China, for the past few months, they have been one of the best performing equity markets because of its reopening. But quite obviously, that initial optimism has now died down. And on a year-to-date basis, China is actually sitting on losses. Because concerns are starting to build over the sustainability of its economic rebound in 2023. So moving ahead, what kind of economic environment, what kind of conditions should investors expect for the rest of this year? I think in short, our expectations is actually for conditions to be to still be relatively challenging. And one of the things that we are expecting for 2023 is for a recession to materialize in the second half of this year. Over the past 50 years, whenever inflation rises above 5%, it has always taken a recession to bring it down. There is no reason why this time around it should be any different. Growth needs to be negative in order for inflation to come down. And on top of that, global monetary policy has never been so tight. It has never been so overwhelmingly tilted towards rate hikes. You just look at the Fed's current policy cycle. It is the most aggressive campaign in almost 40 years. And the last time that monetary policy was this tight, the end result was a recession. So this cumulative impact of the higher interest rates, it will eventually be felt in the wider economy. It will further slow consumer spending. It will also increase unemployment. Some parts of the global economy are already starting to feel the impact of higher interest rates. I think property market is a very obvious casualty. Except maybe Singapore's property market, which is quite resilient. But in other parts of the world, I think property prices have started to come down. The bank failures that we have seen this year, I think that's also another more obvious casualty of higher interest rates. So these bank failures, they have been, it resulted from the impact of all these higher interest rates. I think the good news for investors is that we don't think these bank failures, they are indicative of a financial crisis coming. I think a lot of these banks, they are very isolated cases, so we don't think that this is going to spiral into a broader financial crisis. But having said that, these recent bank failures are also not without negative consequences on the global economy, because what will likely happen is that financial conditions will tighten further, because banks, after these series of failures, what they will likely do is they will become even more conservative. They will tighten their lending standards. And what this also means is that the supply and the availability of credit, the ease of getting loans in the economy is going to be even more difficult for companies, especially the SMEs that are the lifeblood of the US economy. So we could potentially see defaults starting to pick up. And one of the things that I'd like to just highlight in this particular chart also is that leading economic indicators, okay, as you can see from this chart over here, is also showing a significant deceleration in economic activity. So I think there should be no doubts that we are heading towards a recession in 2023. The silver lining in all this is that your household balance sheets, your corporate balance sheets at this point, they are still relatively resilient. So that could provide a bit of resilience to the economy as we head into this recession. So our expectation at this point is for a recession to take place, but it's going to be relatively mild, and it will likely materialize in the second half of 2023. On the topic of inflation, I think our view on inflation is that it will probably remain elevated. And even if a recession does come in the second half of this year, there is no guarantee that inflation will come back down to the 2% target that will allow the Fed to start cutting interest rates. So there are a few reasons why we think that inflation is going to be more persistent than what markets are expecting right now. So firstly, is because the jobs market is still extremely robust at this point. There are still chronic shortages in the jobs market. So I think many of you may have read about the news about the mass layoffs that are happening in the US labor market, particularly in the tech industry. And some of you may perhaps be wondering, how come there are so many layoffs in the US, but yet the labor market has been so relatively robust? The reason for that is because these mass layoffs, they have been offset by a relatively robust demand in other areas of the economy, particularly those services-related sectors, like your hospitality industries, your restaurants, childcare centers, hospitals, all these kind of industries. They are still ramping up hiring over in the US. And this strong labor demand over in these industries have been more than able to offset the mass layoffs that are happening over in the tech industry. And on top of that, this strong labor demand in the US is also happening alongside weaknesses in labor supply. So as you can see from this chart that I have over here, which shows you the labor force participation rate. So labor force participation rate, it has been picking up, but at this point, it still remains below pre-pandemic levels. And what this actually means is that the workers that have left the labor force during the pandemic, they have yet to return to the labor force. And they may never return for a couple of reasons. Firstly, COVID-related deaths. Some of them have unfortunately passed away because of COVID-19 infections. They will not return. Number two, early retirements. Some people have decided to retire early, and these people, they are also not coming back to the workforce. Immigration has also been curtailed because of rising anti-immigrant sentiment over in the Western world. So again, the immigrants, they have been leaving the US, and immigrants have been a key source of labor supply over in the US, which explains why at this point, labor supply in the US is relatively tight. And this has forced many business owners to increase their wages in order to retain their workers. And this is critical because labor cost accounts for about 2/3 of inflation. So for as long as the labor market remains relatively robust, it will be difficult for the Fed to bring down inflation to 2% within such a short period. Now, second reason why we think inflation will remain elevated is because the drivers of the recent disinflation, they could be temporary in nature. So what do I mean by that? So I'll take used car prices as an example. So used car prices, they have been on a steep decline, and they have been one of the key contributors to disinflation over in the US. But this could be about to change because wholesale car prices are starting to show that this category of goods is starting to see price increases. And if retail prices also follows the wholesale pricing, then we could potentially see renewed inflation for this particular category that has been so instrumental to the disinflation that we're seeing over in the US. Commodity prices, also another area of concern. Commodity prices, of course, has been on a decline over the past year and has also contributed to disinflation as well. But again, no guarantees that commodity prices will remain where they are throughout 2023, especially as China reopens. And OPEC now has also engaged in surprise production cuts in order to support oil prices. So any unexpected developments, any unexpected shocks to commodity prices is going to lead to another round of inflation. And last but not least, I think inflation is structural, meaning that it is not temporary. We do think that some parts of this high inflation that we are seeing right now is permanent in nature, and the decade ahead will likely be characterized by a shortage economy. Shortages in a couple of things. I think commodities will likely see shortages because of the many years of undersupply, underinvestment in commodity supply over the years. And what we will likely see in the years ahead is that oil and gas, they will still be needed, no matter what people say about them being high carbon fuel sources. Oil and gas will be needed. Metals will be needed in vast quantities because all your clean energies, all these EVs, your lithium batteries, all of these things need vast quantities of materials, raw materials, your green metals. But unfortunately, I think supply at this point is still relatively constrained. It will not be able to ramp up in time to be able to meet this increased demand for all these green metals. Labor shortages will persist, but this time around not because of COVID-related reasons, but because of demographic reasons like an aging population and slowing population growth. Deglobalization will also push up consumer prices. Globalization has been a key reason why inflation has been so low over the past few decades. But with rising geopolitical tensions, with our countries now starting to turn inwards and focus on self-sufficiency, then this shift towards deglobalization, what will happen is that there will be, supply chains will become duplicated, less efficient, production costs will increase, and ultimately, the ones who are going to bear this higher cost are people like you and me, the consumers who will bear higher prices. So it is our view that inflation will be elevated, I think not just in 2023, but quite likely that it will persist at least over the next few years, which is why we believe that Fed rate cuts in 2023 is very unlikely. Even if the rate hike that we have seen in the latest meeting is going to be the last one in its current cycle, I do think that the Fed will at least hold interest rates at restrictive levels and pivoting to rate cuts at a time when inflation is still way above 2%. I think that's not a scenario that we are expecting at this point. So we are not expecting interest rate cuts to take place in 2023. With recession coming, with inflation likely going to be more persistent than expected, I think our advice to investors is to adopt a more defensive positioning for their portfolios. So that means buying bonds for their portfolios. And with all these bank failures and with rising uncertainty over Fed policy direction as well, I think all the more reason investors should try to incorporate some bond exposure inside their investment portfolios. Now, bonds are actually very attractive. Okay, rising uncertainty is not the only reason why we like bonds. On its own, fixed income looks very attractive because if you look at where bond yields are at right now, they are at their highest levels since the global financial crisis. In the past, I think just a couple of years back, bonds were just giving us yields of about 1+%. So if you're an investor, looking to create a portfolio that gives you a regular stream of income, bonds are a poor choice. 1+%, it can't really give you anything. Which is why investors have been going into equity markets, buying things like your S-REITs, buying dividend stocks. So those were things that could give them decent income back in those days. But times have changed. Instead of 1+%, bonds are now giving you 4%. And if you're willing to take a bit more risk in fixed income markets, you can potentially go into your IG corporate bonds or maybe even high yield bonds. And these fixed income segments can potentially give you even higher returns than just 4%. So it is now possible to create a regular income stream with just fixed income assets. So bonds are very attractive at this point. And also if you compare bonds versus equities, on a relative basis, I think fixed income has also been increasingly attractive. As you can see from the chart on the right, which shows you the yield spread between equities and bonds. So this tells us, this gauge basically measures the amount of compensation that investors are getting by taking on equity risk. So if it's high, it means that equities are more attractive. If it's low, then bonds are more attractive. So you can see that this gauge is actually hovering at near historical lows, which means that investors who are now buying stocks, they are poorly compensated for taking on equity risk. So again, on a relative basis, I think bonds is something really worth considering at this point. But if you're not familiar with bonds, I think our advice to you is to at least try to incorporate some fixed income exposure into your overall equity portfolios, because bonds, in our opinion, it has been getting very attractive. So if you're interested to find out what fixed income options there are, so I think the first place to look at is our ETF focus list, as my colleague has shared just now, under the fixed income category. So I think this will be a good starting point if you're looking out for some plain vanilla fixed income ETF options. And I've listed them, some examples, over on this slide. Now, on equities, I know I said we are positive on fixed income, but just because we're positive on bonds, it doesn't always necessarily mean that you should stay away from equities entirely. A recession and high inflation, it does not always mean that equities will automatically do badly. So I think the key thing for equities is to really be selective in what you invest in. So if you're looking for ideas that can potentially hold up well even in a challenging macroeconomic environment, then one market that we would like you to consider is Japan. Japan is in fact our top pick for equity markets, and there are actually 4 reasons why we like Japan. So the first is because we think its economy is going to benefit from a full reopening of borders. Second reason, Japanese companies have very strong balance sheets. They are entering this potential recession with one of the largest recorded cash reserves and highest share of net cash listed companies. In the past, when interest rates were low, investors have actually penalized Japanese equities for holding too much cash, because this cash could have been better deployed elsewhere to get better returns. But as we head into a potential recession, this cash hoarding behavior, this cash pile that Japanese companies are holding right now, it has all of a sudden become very attractive, because this will provide much needed resilience for Japanese companies as we head into a downturn. Valuations wise, I think Japanese equities are still quite attractive, not just relative to its own historical levels, but also when compared to other developed markets like the US and Europe as well. The bonus of investing in Japan is that you can potentially get currency gains as well from a yen appreciation, because the yen has dropped by so much last year, and it has made it very attractively valued at this point. And with the central bank also likely to embark on a gradual tightening over in Japan, then this could likely lead to further strength in the Japanese yen. So currency gains, I think that's a bonus if you do decide to invest in Japanese equities. For the US, I think we're neutral on it. The only reason why we're not going all out to promote US equities is really because we don't think it's very cheap. It is not a screaming buy in our eyes. But again, given the size of the US economy and the stock market, I think it's really hard to ignore the US. And we do have a couple of options for you to consider, because I think the key thing for US equities really is to be selective in what you invest in. So I think one of the areas that you can consider for US equity exposure is to go for the defensive sectors. I think that has been covered by my colleague in his previous presentation. So I think going for defensive sectors like your consumer staples and healthcare, this is one option, because these are sectors that offer goods and services that are considered essential and for which consumers will pay for regardless of economic conditions. If you're looking for equity ideas that can be inflation hedges, then I think commodity-related companies is something that you can consider, because the earnings of your commodity companies, they are naturally tied with commodity prices, which are in turn highly correlated with inflation. So by definition, commodity companies, they generally perform well when inflation rises, and that actually makes them a good hedge against inflation. So again, a couple of suggestions over here. You can find it under our commodity category in our ETF focus list. But if you just want one ETF that can give you broad-based exposure to the entire commodity space, then I think the Global Natural Resources ETF is something for you to consider. Another area that you can potentially consider is value and quality stocks over in the US. Value stocks are those that are attractively valued relative to fundamentals. So if your S&P 500 is overvalued, That also means that focusing on the cheaper and more attractive areas of the market is a prudent strategy. And quality is also something that we like as well. So quality stocks are those that have a strong pricing power, market share, and balance sheets as well. So even if we head into a recession, even if inflation remains high at this point, I think the fact that these companies are highly profitable, they are able to pass on higher costs to consumers, I think that makes them relatively resilient as within the US equity market. So consider value and quality stocks. And I think the last group of companies that I'd like to highlight is companies that are generally beneficiaries of long-term trends like digitalization, AI, cybersecurity. I've listed 2 examples here, but for a more complete list of ETFs that can give you exposure to mega trends, do check out our ETF focus list under the tactical plays category, where you can find more ETF ideas that can give you exposure to trends like AI, cybersecurity, as well as cloud computing. Now, if there is one market that you need to avoid, I think it's China. We're still unconvinced with China at this point. We do agree that the worst is likely over for China's economy, but we do think that markets are too complacent about the sustainability of China's recovery. A few reasons why we don't like China. I think in terms of the timing of its reopening, China is reopening at a time when the rest of the world is slowing down, which also means that its exports industry will likely face headwinds in the year ahead. And this crucial pillar of growth that has held up the economy through the pandemic, it is now gone. Property market, I think, is also unlikely to stage a quick recovery because despite the government going all out to rescue the property sector, we have continued to see developers defaulting. Consumers, they still lack the confidence to buy properties. And I think most developers, they're still struggling to repay and restructure their debts at this point. So we have no doubts that eventually there will be a recovery, but this is going to be a long process, and which also means that it will be hard to replace this growth driver overnight. Bearing in mind also that China's property market, it consists about 20 to 30% of the overall economy. So it will be hard to replace this growth driver. But even if we are wrong about China's economy, if China's economy does exceptionally well this year, I think there are also longer-term issues to worry about for China, which includes a shift to a more top-down, state-controlled economy under the leadership of President Xi Jinping. Rising geopolitical tensions is also here to stay. And also the many years of abrupt policy shifts, I think it has severely dented business confidence. So a lot of foreign businesses, they are now less confident that their businesses will, their operations will not be disrupted over in China. So that has led a lot of companies to start shifting their operations away from China. The most high profile one recently was Apple. So Apple has been in China for very long, but Apple too is also starting to hedge its bets. It is starting to shift its production facilities away from China into markets like Vietnam and India. So if you also agree with us that the China's long-term growth story is it's permanently impaired, then I think there are a couple of markets that you can consider for your portfolio. So I think 2 markets that I've highlighted here. These are markets that can potentially benefit from the shift away from China. One is ASEAN. The other one is India. But if you really must invest in China, I think our advice to you is to align your portfolios with China's priorities. So that means investing in SOEs and also companies in our favorite industries like your clean energy, EVs, semicons, as well as technology. If you haven't already realized, I think most of these companies that can benefit from supportive policies are your A-share companies. So if you want to invest in China, I think the opportunities are increasingly found in the A-shares market. But having said that, I think even if you invest in SOEs and companies in favored industries, that it is also not a risk-free thing, because the risk of investing in all these companies is that the government can change its mind anytime. In the past, there has been favored industries that have fallen out of favor. If it has happened in the past, it can happen in the future. So I think Chinese equities at this point, it carries a higher degree of risk in our point of view, and it is our desire that we advise our clients to underweight Chinese equities within their investment portfolios. Okay, so just to sum up what I've shared today, I think in a nutshell, we think this year is going to be challenging. we're expecting inflation to be high. We're also expecting a recession to hit in the second half of this year as well. So because of that, I think our recommendation is for investors to be more defensive. So more fixed income exposure inside your portfolios as compared to equities. For equities, I think it's important to be selective. Japan is one of the markets that we like in particular. For US equities, I think we like defensive sectors, value and quality, as well as beneficiaries of long-term trends. And for China, I think we don't like China in a nutshell, and we instead like markets that can benefit from the shift away from China, so particularly ASEAN and India. So with that, I end my sharing. Thank you so much for your time.
Right. Good morning, everyone, and welcome again to ETFestival 2023. So my name is Terjun, and I'm also from the research and portfolio management team here at iFast. So earlier today, you have heard my colleagues share about our new ETF focus list, some of the changes that we have made, and also some of the new ETFs that we have brought on this year. So today, I am here to share an update on a sector that has been on our focus list since the first iteration came out back in 2018. And this also happens to be one of my personal favorite investment ideas. And this idea is none other than the semiconductor industry. Now, if you've been attending our webinars for quite some time already, there's a very good chance that you have heard us talk about this sector before. But unfortunately, with so many things going on in global markets these days, we haven't really had the opportunity to share an update on this sector, which is why I will be spending some time to revisit our investment thesis, but more importantly, to share with investors why you should always have this sector on your watch list. Right, to start things off, before we dive into the investment thesis, I'll just like to start with a quick introduction on what semiconductors are and what the companies in the industry do for the benefit of those of you who are not familiar with this industry. So semiconductors, they are basically components of every electronic device. You can find them everywhere in your iPhone, in your computer, and even these days in your washing machine, in your coffee machine, you also can find semiconductors. And as a matter of fact, the use of semiconductors today, it has become even more widespread compared to the recent years, thanks to all the smart devices that we have around us. And the companies that operate in this sector, they can be classified into four main groups, as you can see on the screen over here. So first up, we have what we call your pure play foundries. So these are companies that only do manufacturing of semiconductors. They don't do any design. So examples of these companies includes TSMC, which is the world's largest semiconductor foundry, and also its competitor, SMIC, which is the largest semiconductor foundry inside mainland China. Now, on the opposite end of pure play foundries, you have what we call the fabless companies. So fabless companies, they only do the design of semiconductors. They don't do any of this manufacturing. So what they do is, after they design the chips, right, what they'll do is they will outsource the manufacturing to foundries like TSMC or SMIC to make the chips for them. So this model, it is often more effective, more cost effective, because the cost of owning a fabrication plant, it is extremely expensive. So to give you guys some idea of how expensive it is, recently TSMC announced that it will be expanding its fabrication capacity in the US by building 2 new fabs in Arizona. So the cost of these 2 new fabs, they run up to about $40 billion US. So that is incredibly expensive, and also the reason why many companies, they actually opt to go for the fabless route in order to cut costs. So for the third category of companies, we have what we call the integrated device manufacturers, or IDMs in short. So basically, IDMs, they, I think you can consider them the best of both worlds. So they do both the design and also the manufacturing of semiconductors. So examples of companies in this category include Intel. So the reason why IDM models are sort of popular is because these companies, they can have absolute control over every step of the design process and also the manufacturing process. And this ensures that semiconductors, they can be made to the exact specifications as required by these companies. So last but not least, we also have your equipment manufacturers. I think the name is pretty self-explanatory already. So these are companies that make equipment such as your EUV lithography machines that are used to produce chips. So examples include the Dutch company ASML. So together, all these companies, they make up the entire semiconductor industry, and they come together to produce things like your microchips, your memory cards, graphic cards, so on and so forth. So now that you have, hopefully you have a better understanding of what this industry is, let's take a look at how they've been performing over the past couple of years. Now, in terms of share prices, I think you can see very clearly on the chart that semiconductor companies, they have done really well over the past few years, especially in the period after the pandemic. And even though share prices, they have fallen throughout the most of 2022, they are still up by about 20% year to date. However, earnings of many of these semiconductor companies, they have not been able to keep up with the surge in share prices, resulting in more expensive valuations for the sector. And the main reason why earnings, they haven't been able to keep up is because the semiconductor industry, it is going through a down cycle at this point in time. So on the whole, the post-pandemic years have been great for the entire US semiconductor industry with record high revenues and also double-digit earnings growth for many of these chip makers. Unfortunately, good times, they don't last forever, and by the second half of the year, there are already clear signs that the industry, it is sliding into a downturn. So most notably, as you can see from this chart over here, semiconductor sales, it turned negative for the first time since 2019, falling by about 10% year over year in the fourth quarter of last year. And if we look at things from a monthly basis, we can even see that semiconductor sales, it actually first turned negative in September 2022, which indicates that this down cycle, it actually started way earlier. And while this initial drop in sales, it is already considered significant, we think that things will likely worsen over the coming quarters as this down cycle continues to play out, which is of course bad news for semiconductor stocks. Now, while there are a number of reasons that can explain why sales growth has been falling, most of these reasons can actually be traced back to imbalances between supply and demand for semiconductors. So at the start of the pandemic, as most people were stuck at home, trends such as remote working, they were starting to gain traction, resulting in heavy demand for semiconductors. So during that time, during the lockdowns, many people were buying PCs, they were buying monitors, iPads, just so that they can work from home. And at the same time, businesses, they also use the pandemic as an opportunity to digitalize their operations, to make things even better and to stay competitive in this tech-driven future that we are heading into. So the end result of all these things is that there has been an unusually high demand for semiconductors, so much so that it actually caused a shortage back in 2020, 2021. And because of this shortage, many of the governments and so customers of semiconductor companies, they put pressure on chip makers to expand their capacity. And as a matter of fact, if you take a look at the chart over here, you can see that the total industry capex, it actually grew by about 27% in terms of a compound annual growth rate between 2021 and 2022. So this is significantly higher compared to the growth rate of just 6% in the 3 years prior to the pandemic. So not surprisingly, this sudden and sharp increase in capex resulted in a supply glut. And unfortunately, the timing of this supply glut, it cannot be worse as it has come at a time where chip demand is dissipating rapidly, resulting in the down cycle that we are in today. So why exactly is chip demand falling? And I think it's no secret that the global economy, it is on a much weaker footing compared to the start of 2022. We have things like persistently high inflation, we have aggressive central bank policy. All these things, they have slowed economic growth substantially, thus raising the risk of a recession. And the recent collapse of Silicon Valley Bank and also other regional lenders has also added to concerns about the health of the global economy. So thanks to this greater economic uncertainty that we are experiencing today, chip demand has also fallen drastically. Trapped between high inflation and also high borrowing costs, consumers, they have been cutting back on spending. And according to data published by IDC, shipments of consumer electronics such as your PC, smartphones, and even your wearables, they have all declined in the first quarter of 2023. And in particular, Apple's MacBook shipments was the worst performing of the lot, falling by about 40% as consumers traded down to cheaper alternatives. And another reason that can explain why chip demand is falling is because spending has also gradually shifted away from goods and towards services such as your travel and leisure, as most countries are more or less reopened already. So the thing is, with the pandemic boom behind us and also a global recession looming, we think that shipments of consumer electronics, they are likely to remain weak for the foreseeable future. And to make matters worse, inventory channels along the semiconductor industry, they are also currently bloated. And this is likely because many customers, they double ordered during the shortage. So double ordering, it is a practice of placing multiple orders for the same part. And this was quite prevalent during the early days of the shortage because many companies, they are kiasu. They are worried that they can't get the components that they need, so they place a lot of orders. So at the end, what they have is that they accumulated a lot of inventory. So if you take a look at this chart over here, you can see that inventory days, which is the average number of days a firm takes to sell off its inventory, and also the inventory to sales ratio, they are both rising. So both these measures, they indicate that turnover has been slowing. In other words, sales has been slowing. And with demand falling and inventories rising, chip makers, they will likely stop new orders and slash prices in order to get rid of all their excess inventory. So this is something that we are already seeing. So Samsung, for instance, said that it would meaningfully reduce its production of memory chips after a pile-up in inventory and also a collapse in memory chip prices caused the company to report one of the worst operating profits since the GFC. And on the other hand, its competitor, TSMC, is also bracing for weaker sales in 2023 by cutting its capex spending. And according to some of the statements made by TSMC's management in their latest earnings call, they noted that this inventory correction, it is likely to last throughout 2023 and things should only start to pick up in 2024. But the good news here is that down cycles in the semiconductor industry, they don't last forever. And despite the current downturn, we are still confident that semiconductor sales, it will eventually recover to higher levels than before, as it has done so every single time in the past. And this is because the world is becoming increasingly tech-driven. Therefore, we think that it is not a question of whether or not this recovery will occur, but rather it becomes a question of when will this recovery take place. And according to our estimates, we think that the industry could return to double-digit growth as early as 2024. And according to estimates from McKinsey, the semiconductor industry, it is poised to become a $1 trillion industry by the year 2030, which represents an annual growth rate of about 8% between now and then. And demand for chips, it is set to be driven by structural factors, such as an increase in the number of semiconductor applications, and also the rising silicon content in them. So these days, the use of semiconductors, they are extremely widespread. Recent innovations such as your ChatGPT, the metaverse, these things, they were only made possible because of advancements in semiconductor technology. And the rising number of smart devices in the world today, it is also driving demand for semis. And apart from this, the second reason is that the silicon content in most existing applications, they have also increased significantly over the years. So you take cars, for instance. Even though cars, they are still largely mechanical since the start of the 21st century, thanks to new innovations such as autonomous driving, the silicon content of cars today, it is estimated to have grown by more than 5 times compared to a decade ago, and it is still expected to grow even further. And according to projections by Intel, semiconductors will actually make up more than 20% of a vehicle's cost by 2030, which is a 5-fold increase compared to 2019. So the bottom line is this: as the world becomes increasingly tech-driven, semiconductor demand will only become stronger than before, and we think that this will bring immense benefits to the entire industry as a whole. Now, down cycles in the semiconductor industry, they come about once every few years, as I've shown you from the sales growth chart earlier. And when they do, we think that it is a buying opportunity that is not to be missed. Now, I understand that as investors, it is in our nature to try and pick the exact bottom of the cycle. But the truth is, it is almost impossible to do so unless, in hindsight, or unless you are incredibly lucky. And more often than not, investors who are trying to catch the exact bottom of the cycle, they end up missing out on the opportunity altogether. So what we think is that instead of trying to pinpoint where the bottom of the cycle is, what we can do is to identify a range of buying and also selling opportunities. And in our opinion, the best time to start accumulating semiconductor stocks is during the start of down cycles, when share prices are falling and manufacturers are cutting back on production, times such as now. And as scary as things might seem today, down cycles, they can be a great opportunity to pick up shares at a discount. Now, moving on to valuations. So even though valuations are not the cheapest at the moment, and there is also a risk that share prices may continue to tumble further, we definitely believe that there is long-term value in this industry. And if we only focus on current valuations, we can see that the industry is trading at about 23 times PE, which is considered expensive by our standards. However, if we were to stretch our investment horizon out further into the future, let's say to 2025, we can see that the industry is currently trading at a PE of only about 15 times compared to our fair PE of 20. And we think that when the recovery kicks in, we can expect to see strong double-digit earnings growth, which should help to drive share prices higher. Because after all, in the long term, share prices, they are ultimately driven by earnings. And overall, we estimate that semiconductor stocks, the industry as a whole, has an upside potential of about 30% from current prices. And for an industry with such solid fundamentals, the growth prospects, they are simply immense. And while we understand that conservative investors, you may want to wait a little bit and to see the trend, or may want to wait for more clarity before you start buying in, we do think that longer term investors who actually believe in this investment thesis, you can actually start buying now using a regular savings plan before switching to lump sum investments should valuations fall in the future. And of course, this is ETFestival, so I will be recommending ETF for you to do so. And the ETF that we are recommending for the semiconductor industry is the VanEck Semiconductor ETF. The ticker code is SMH. This is listed on the NASDAQ Stock Exchange. It's a US listed ETF. So basically, this ETF seeks to replicate the performance of the MVSM HTR index, which tracks a basket of 25 US listed semiconductor stocks. So because it's US listed, you can also find foreign companies like TSMC and ASML, which are not US companies, but they are listed on US exchanges. So the index methodology for this ETF, it applies a modified market cap weighting. In other words, it favors the largest and also the most liquid names in the semiconductor industry. So if you take a look at the table over here, you can see top 10 holdings. I'm sure you recognize many of the names like NVIDIA, AMD, Broadcom, Qualcomm, and more. And just a fun fact, this ETF has also been on our focus list since 2018. We haven't changed it because we think that going through the ETF selection methodology, this ETF continues to rank highly among all its peers. So one of the things that I personally really like about this ETF is its expense ratio of just 0.35%. So at an expense ratio of just 0.35%, it essentially means that you're only paying about $3.50 each year for every $1,000 that you invest. $3.50 nowadays probably can get you 2 cups of coffee at a coffee shop only. And another thing that I like about this ETF is its high liquidity. It has a very healthy liquidity profile with close to 4 million shares changing hands each day. So as my colleague has explained earlier, liquidity is important in ETFs because the higher your liquidity is, the less it is easier to enter and exit your positions, and you have less of a negative price impact. So overall, I think that ETFs, they are a great way for investors to get diversified and also cost-effective exposure to certain sectors, assuming that you don't have the time to monitor multiple stocks, or for those of you who are not confident with your stock picking skills. Now I've come to the final slide of my presentation already. So if there's only one thing that you take away from my sharing today, I think it should be this. And that is, without semiconductors, all the technology that we enjoy today, it would not exist. And as the world we live in becomes increasingly digitalized, the demand for semiconductors will only become stronger. Ladies and gentlemen, I've come to the end of my sharing today. I'd like to wish everyone here all the best in your investing journey, and I hope that all of you can make lots of money this year.
So I think in the morning, a lot of our speakers have already shared on different products and also how the markets are moving. So maybe this is panel discussion. We'll do something a little bit different. We'll be asking what investment director, a senior portfolio manager, and a manager of our FSM investment advisory team, what do they invest in? Okay, so maybe we can start with Kenny. What was the first ETF you personally bought? When did you start investing in that ETF, and how did it fare, or how is it faring right now?
Yeah, I have been in the fund management industry for more than 30 years, so hopefully I don't look my age. I'm the oldest here. I actually started in the industry back in 1991. At that time, I think if I were to turn back the clock, I actually experienced quite a number of crises in the past. So the first ETF, because I was a fund manager, so I always think that I can pick stock myself pretty well. But then when ETF started to come up, I think there's a very interesting low cost proposition, especially for those markets that I don't know. So back in 2008, during the global financial crisis, I actually invested in iShares, the US MSCI US ETF. So that was the first ETF that I invested in. I actually exited prior to joining iFast at 2019. So I make a return of about just 150%. And if I were to hold on till now, it would have returned like more than 200%.
Well, that's very impressive returns, actually. Okay, what about Weiren?
The first ETF that I ever bought for my portfolio was actually the STI ETF. So I think when I first started out my investment journey, I like to do stock picking. But one thing that I realized was some of the stocks that I picked didn't really quite outperform the STI ETF. So I figured that the best way to go about doing your investment is if you can't beat them, you join them. So that was why I bought the STI ETF. How has it performed? To be honest, I think it has not performed very well because the fact is, over the past, I think 10 years, if you compare the performance of S&P 500 versus the STI ETF, I think Singapore has been trashed by US equities. So along the way, I realized that, and I figured that perhaps having a bit more exposure outside of Singapore was a prudent thing to do. I was also under the influence of Warren Buffett because he said, just having exposure to a low-cost S&P 500 index fund, that's more than enough for a portfolio. So I decided to go into US. So the second ETF that I bought was actually the S&P 500 ETF.
Okay. Yeah, and what about Catherine?
Personally, myself, because I do have a portfolio of mostly unit trust investment initially, so it's already globally diversified and some regional unit trust available that's actively managed. But for myself, I started investing probably about 2-3 years ago during the pandemic period because I actually like some of these. The earlier presentation, Tejin, our equity analyst, has actually presented about the semiconductor ETF. So that was the one that I've invested in because I like some of the names that are in the ETF like TSMC, Nvidia, Intel, and so on. But it's very expensive to keep buying individual counters, and it doesn't make economical sense to buy like 10 of them because I'll be paying so much of the transaction fees. So hence I taken up the ETF that the Jin actually recommended, and over the course of the last couple of years, you have definitely seen better days, but it's still currently, happy to say, it's still in the money. Yeah, but definitely here for the long term lah. Yeah.
That's very interesting sharing from our panelists. So on our panel today, right, our three panelists are actually at different life stages. So Kenny is nearing retirement. Weiren, he's a father of two, and Catherine, she got married last year. So maybe Kenny, as someone who is nearing retirement, right, does the recent market turmoil actually worry you?
Yeah, maybe it's also perhaps my exposure to the industry as a fund manager. So actually the turmoil doesn't actually worry me. I think the important thing to note is that as long as you know what is the risk that you can take and also have a proper cash flow planning, to me, every market turmoil actually present you a great opportunity to grow your wealth. And that's how I did it over the past 30 years.
And for Weiren, as a father of two, what are your investment objectives like?
In terms of my investment objectives, I think I've got two. One is personal, which is to invest for my own retirement, to ensure that my portfolio assets will be able to last me through my retirement days. I think that's my primary investment objective. The secondary investment objective, it relates to my kids. So what I've been doing for them is to set aside money for them on a monthly basis. in a pot of money to be invested in longer term equity ideas. And the intention of this pot of money really is to help them out with their future, big ticket expenses like your university, wedding, and hopefully there's some money left behind for their first property purchase as well.
Yes. I think that's what most parents are doing. And for Catherine, as a newlywed, what are the factors that would shape your investment objectives?
Actually, for myself, because I got married during the COVID times, I was quite lucky that I didn't have to have a very elaborated wedding. So to be honest, I did not spend a lot. So what I actually mainly spend on is on my renovation. And I think in Singapore, if you're ever done renovation, it's so expensive, be it all the carpentries and all the different tiles and so on. So a bulk of my money actually set aside for that. And I've took out a couple of those renovation loans as well as those installment plans. So I think this shapes my investment objective, as in I do want to grow my wealth, but at the same time I do not have a very huge large investment lump sum to start investing with. So personally, what I did is, because currently I'm still serving these loans, which was quite fortunate, they are locked in at a very low rates. At this time, I'm actually just doing a regular savings plan into like those ETFs and some unit trust investments as well for a very long term, because all these are very bite-sized investments and it's more digestible for my finances.
Okay, thank you. And I'm sure everyone here, some of you, or even most of you, have access to social media. And social media these days, there are a lot of self-proclaimed, investment influencers, investment gurus, all that, and their clickbait videos, all that, right? So maybe I can just ask Kenny, how do you filter like which ones are genuine? Have you ever come across any of them?
Yeah, I just have to be very honest with everyone. I'm not a big fan of social media. So I think there's a lot of noises out there. So I started in the industry like 30 years ago, and when I conduct research, I go and take an annual report and I read it. The Warren Buffett way, right? You have to read the annual report and do your own homework. So in a way, I think social media give you a lot of information with regards to the different investment opportunities out there. But again, they also provide you a lot of what I call trap that, potentially if you don't do your homework, you can get hurt. So what I would suggest to everyone here is that if you want to invest, your hard-earned money, you better do your homework. Let's say if you're too busy and you're not able to do a lot of what we call due diligence, then I think one of the easiest way is to invest in a broad, diversified asset class like an ETF. So I think that, first of all, will diversify your risk significantly, and secondly, get you the exposure that you want to get.
Okay. Weiren, do you have any response?
I feel that, Kenny doesn't really use social media. Actually, neither do I. I don't have an Instagram account, but I do go onto Facebook. But I think one way to really tell whether some of these, influencers, whether they're giving good advice or not, is to see whether they're giving dubious advice. So if you see people telling you that, hey, I've got this this investment tip that can give you guaranteed 10% returns on a yearly basis, something is wrong. Okay, nothing is guaranteed in the world of investments. Or if they guarantee you a certain level of gains in a certain period of time, I think, these are red flags that we look out for. But if the person is just voicing out a view, which pretty much anyone can do in the world of social media, I think no pain hearing them out, see what they have to say about a particular company or a particular market. If you would like to do homework on the influencer himself, I think Sidley provides quite good crowdsourced advice on some of these influencers. So you can check out Sidley reviews as well. But ultimately, I concur with Kenny that ultimately, I think it is your responsibility to decide what investments you want to buy for your own portfolio.
Thank you, Weiren. And Catherine, I'm sure there are a lot of clients who send you these videos and ask for your advice, right? Like, how do you usually respond?
Yes, actually, yeah, some clients would email me and ask me like, "Is this legit?" But I do concur with both of them that if it's too good to be true, it is definitely too good to be true. And also, definitely doing your own homework before you invest is very important. But I do think like some tips, like for instance, I think when T-bills was the yield was across 4%, I think there was a lot of these forums and these individuals that recommended investing in T-bills using your CPF monies. Then I thought, I mean, mathematically, it actually works out and it does actually make sense. So I do think that on social media, yes, there could be very true, legit advice, and sometimes it could just be too good to be true. And I think most of the time it's best to dwell deeper in it and see what is the thing that they are trying to sell and what's the motive behind all these investors or these influencers trying to sell you these ideas for. Yeah.
Okay, thank you. And I think Kenny and Wei Ren, both of you have children, right? So if one of your child, like they saw one of these videos and they came up to you, what would you tell them? Wei Ren first.
I think if my child comes up to me and show me one of those influencer videos, I think my first reaction would be to ask them what they think about it, whether they agree with it. So I think ultimately, after watching all these videos, you need to have a view on that particular instrument that the influencer is talking about. If they are talking about like Singapore banks, for example, and painting it in a negative light, I will ask my child whether he agrees with the analysis given by the influencer, if not why. So at the end of this process, I hopefully my child will be able to come to a conclusion of why he is positive or negative on Singapore banks. Because when market conditions are tough, one of the ways to ensure that you do not do knee-jerk reactions is to remember why you buy this investment in the first place. So if you can't remember, why you even buy this stock in the first place, it's very easy for you to be overcome by your own, emotions. When there is a sell-off, you will definitely panic and you will sell off all your portfolio. So I think having that conclusion, whether he agrees with that analysis, I think that's important.
Okay, that's food for thought. And for Kenny, what's your opinion?
Yeah, I will always tell them there's no free lunch. I think when something is too good to be true, always treat it with skepticism. And ultimately, a lot of news flow out there will tell you this is a great investment opportunity. I think in the crypto space, there has been a lot of this. I'm not talking about the mainstream Bitcoin and all the others, but even some of the very, very speculative, crypto. So one of the way I taught my, my university going daughter. So she heard from a friend that her friend made like $1,000-$2,000 over a space of less than a week. Then what I did to her is that, do you believe that money is so easy to be earned with such little investment capital? So what I did was I actually opened a crypto account for her. And I gave her about $100 to invest in. And over time, you monitor, what is your kind of investment. And ultimately, she learned the investment experience and it turned out to be, of course, a bad one. Then she'll realize that actually, money is not so easy to be made, right? And easily you hear from rumors, hearsay. I think that's the best way to put your money into the drain.
Thank you, Kenny, for the wisdom. And okay, I think a lot of our clients are worried about a recession in 2023. So, and it seems imminent, because of a lot of factors pointing to it. So, how do you think investors can leverage on ETFs to weather the storm? Maybe we can start with Catherine first.
Yeah, because recession is a big thing because a lot of portfolios will definitely perform poorly during this time. So, other than choosing the right ETF or the right investment tool, I think it's also important to boil down to individuals' risk profile and also like what Raymond said, to understand why do you even invest in the product in the first place. So I think like probably right now investing in high quality companies will definitely be a bit more resilient in the portfolio so that there's lesser drawdowns. I mean, these equity markets do not defy gravity. So when there's a market risk, everything comes down. Probably earnings do revise and performance of the portfolio does perform poorly as well. But I think markets are always forward looking. So probably, when recession is coming, markets has already priced this and is also reflected in the equity markets as well. So I think other than investing in high quality companies, we also advise investors to keep some allocation into fixed income assets like very high quality bonds as well. All this helps to reduce the portfolio volatility and let them, sleep better also lah. Yeah.
And Weiren?
I think I've highlighted in my presentation just now. I think just because a recession is coming, it doesn't always necessarily mean that investments, your equities, it will necessarily do badly. So I think the key thing is to be number one, selective, and number two, have a diversified portfolio, and that is where ETFs comes in because they are low cost and they are also diversified investment vehicles for you. So I think having that diversified portfolio can be a very good thing, a very good anchor for your portfolio as we go into more volatile and more uncertain times in the year ahead.
And Kenny?
Yeah, actually, to me, trying to time the market is always a very challenging thing. And usually you want to sell at the worst possible time and you want to buy at the worst possible time. So, and I think the mindset of a lot of investors, as far as I know, me included, is that we know how to control and we know how to decide what we should be doing. So for individual stocks, let's say, for example, if something nasty happened, let's say, for example, during the COVID and everybody was worried about Disney, nobody's visiting Disneyland. And then, you just, when you're holding a Disney stock, although it's still a blue chip stock, you get very anxious. So when you see the stock price tumbling, you tend to react. And that could be the worst possible time for you to exit the stock. But on the other hand, if you were to look at ETF, because there's so many positions inside the ETF and it's diversified, sometimes you don't even know what's inside the ETF, right? So you tend to take, I think, a more casual view in terms of holding on, when the times are bad. And then you also keep onto it when times are good because, you can't actually decide which is the best stock within the ETF. It's just a good ETF, for example. And then you tend to kind of like, keep holding on to the position. And if you're adding on to the position so I think over a longer term, you may potentially get a better risk reward from investing in ETFs.
Okay, thank you. And I think there are definitely a lot of clients who are concerned about recession. So maybe Catherine can share what are the concerns that the clients usually have.
Yeah, some clients do have for instance, when markets are better, they invested in some high yield companies. So definitely the risk is a lot higher compared to a portfolio of ETF that invest in a high yield bonds. So there's more homework to be done, especially when recession is coming. If you're holding individual counters or bonds or what, you might want to look carefully into their balance sheet and to see how is their businesses and so on are being affected, and do they have enough liquidity? Because I think cash is king, especially in this kind of high interest rates period. Yeah.
Okay, thank you. And I think one of the last few questions that we have, for investors who wish to start investing but have yet to, do you think the dollar cost averaging into an ETF is a good way to start? Kenny can start first.
Yeah, I think for retail investors, dollar cost averaging is definitely a good strategy to have in mind. Because, as I mentioned earlier, trying to time the market is always very, very challenging. Yeah? You won't buy when the market is having a sell-off, and you won't, sell when the market is, doing very well. So a dollar cost averaging approach, I think, is a very disciplined and very systematic way to actually deploy your savings and your wealth into the asset class that, you would like to invest in.
For Weiren?
I think it's good. It's a good way for investors to invest. But I won't repeat what Kenny has said, but just add on to say that I think a lot of people, when it comes to ETFs, they don't invest in it because many of them, they don't really understand how it works. So RSP would be a good starting point for you because with just $50, you can actually get started with RSP. So the maximum amount of money that you can lose in this ETF is just $50. So while you do your RSP, you can actually do your homework in the background to decide which are the ETFs that you really want to invest in, which are the ETFs that you are willing to put a lump sum in, while still having that exposure to markets using RSPs.
Yeah, I think that's a very good way to make use of the RSP, especially of the 0% processing fee FSM1 is offering. And for Catherine, what do you think for?
I do think that, for investors who have not yet started investing, I think it's very daunting to buy individual stocks, especially when the stock prices moves up and down quite wildly, especially for those tech stocks or other names that you might see of. Like sometimes it moves 5-10% in a day. So I think to get your toes wet and to dip your, to spread out your investments, definitely a ETF would help to diversify and also dollar cost average as you go along, because you never know when the bottom is. Yeah, but you can definitely average in and lower your costs and accumulate more units when prices are lower.
Okay, thank you. Okay, last question for all our panelists. What is an ETF on your watch list right now, and what is interesting about it? You can start with Kenny.
Yeah, I wouldn't say I have just one ETF on my watch list because, like for example, depending on your investment objective in the current environment, like for example, if your objective is to preserve capital and maybe get a slightly better yield than putting your money in the bank, then I think the likes of like the Nikko Sing Dollar investment grade bond, those that offer you around 3 to 4 or even slightly higher yield would be good from a capital preservation angle, especially if you sincerely believe that recession is definitely coming and it's going to be a bad one. The other way I look at it is that you should also watch some of the equity ETF. I think earlier I have seen De Jun presented on the VanEck semiconductor ETF. I mean, those are things that won't change. It will be like a structural trend. So I think when again, if you think that the current price is low enough, you can start accumulating a position. If it goes down more because the recession actually is getting worse, then you can accumulate more. And even like a very broad base S&P 500, if the market correct like 20%, I'm not suggesting it will, then I think that would be a way of you looking at some of those broader exposure equity ETF. So I think that should be the one that you should be mindful of.
Okay, Weiren?
I have 2 ETFs. I'm doing RSPs for 2 ETFs at this moment. These 2 ETFs give me exposure to some of these mega trends. One of which is semicons. The other one is actually a metals ETF. So to me, I think mega trends, as what Kenny has mentioned, I think it is something that transcends your short-term economic conditions, your interest rate cycles. So it doesn't matter where interest rates are in the future. It doesn't matter whether inflation is stubborn or not. I think a lot of these trends will be set in motion for the next few decades. So I think semiconductors is one ETF that I have on RSP because I believe in a long-term case for semiconductors and the increasing digitalization of the global economy. The second one is the metals ETF by VanEck. If you're interested, you can go to our ETF focus list. It's the ticker code is REMX. So the reason why I buy this ETF is because I believe in the green transition. But sometimes, if you think back about the gold rush, okay, during the gold rush, instead of buying gold, there are many other things you can buy. Okay, you can buy a business that sells the shovels and picks. You can also buy businesses like Levi Strauss that sold jeans to all these miners during the gold rush, and all of these businesses were extremely profitable. So if the current green energy transition is the gold rush, then the picks and shovels in this case will be your all these metals, all these raw materials that will go into the construction of your wind turbines, your EVs, and also your solar panels. And some of these green energy technologies, honestly, they are still not proven yet. They may not work out in the future. So I think the best bet, if you want to look for an ETF that plays on the green energy transition, go for a metals ETF instead.
Okay, thank you, Warren. And for Catherine?
Personally, myself, I also have the VanEck ETF on my watch list, but not the VanEck Semicon or the metals one, but it's the VanEck Morningstar White Boat ETF. So why I like this ETF and I find it very interesting is because this white mode investment concept actually originated from Warren Buffett. He likes to buy companies at a good valuation and also has strong moats around their businesses so that it can protect its profits from competition. And these companies do show, I think Morningstar, the research equity team, do classify them into 5 different sources of economic mode. So one of them includes high switching costs. Second one is like intangible assets like patents, IPs, and also brand equity and so on. The third one is cost advantage, whereby the companies have low costs in generating their products and they get very good high margins from it. And fourth is the network effect. So like the more users they have, it benefits their current users as well as the new users. Yeah, so like services like Google, Visa, those are companies with wide economic moat. And the last one is the efficient scale. So that means in a industry that generally do not have a lot of competition, and they are naturally a monopoly there. So there's a very high deterrence for new competitors to join in due to high capital startup costs and so on. So the Morningstar Equity research team will classify based on these 5 economic mode, and then on top of this, they look at companies that are trading below their fair estimate value. So like example, like maybe they target the price as 100, but currently the stock is actually trading at 70, for instance. So they will include these stocks inside their index itself. So this ETF actually tracks this Morningstar White Mode Focus Index. So the stock code goes by MOAT. So this is like the castle with the moat with deep trenches around it. Yes, and they have the global international version of this ETF with the similar concept of choosing economic mode. It's called the VanEck Vector International Mode ETF. So that goes by the ticker MOTI. Yeah, so I just thought this too is quite interesting. Yeah.
Okay, thank you, Catherine. So we've come to the end of our panel discussion. I hope you have taken note of the ETFs they have shared. Okay, back to you, MC.
Hello, welcome everyone. Thank you so much for joining us today. So I'm Hui Shi and I'm from the IFAST research team. And so for today, I'm here to talk about a very popular investment style called income investing. So what is income investing is essentially centered on building an investment portfolio which aims to produce a passive stream of regular as well as sustainable income payouts. So when it comes to investments, there are actually 2 main sources of income, which are dividends as well as bond yields. Now that also brings me to the key building blocks of an income portfolio. So what exactly should go into an income portfolio? The first building block that we have identified is fixed income. They are also known as bonds, and we think that they can form the foundation of an income portfolio. So fixed income investments, as their name suggests, they tend to pay out a steady stream of income at a fixed interest rate to investors. And moreover, most bonds, they are designed to provide capital preservation, and as such, they tend to be less volatile. So this helps investors to balance out equity market volatility in a portfolio. Now, government and corporate bonds, they are your most common types of fixed income investments. And these bonds, they also tend to come with a credit rating. Entities with very strong balance sheets, they tend to issue debt which are known as investment grade bonds. So examples of investment grade bonds will be those issued by the Singapore government or by very strong companies. And on the other hand, there are also bonds which have a lower credit ratings. And for this kind of bonds, they tend to carry a higher level of risk. So they are called non-investment grade or high-yield bonds. So this kind of high-yield bonds, they can be issued by governments of emerging markets or by riskier companies. Now next, the second building block of an income portfolio that we have identified is high dividend equity markets. Investing in a very high dividend equity market can provide investors with a diversified exposure to high yielding stocks from different sectors. So to give you some color here, we have listed down all the markets under our research coverage, and they are being ranked by their dividend yields. So right at the top, you can actually see that we have Brazil. Now Brazil is a very high dividend yielding market because it around about 60% of its index constituents, they are from the financials, materials, and energy sectors, which pay out very attractive dividends. So next, the market with the second highest dividend yield is actually unsurprisingly Singapore. The Singapore equity market, as we know, it is pretty much focused on bank stocks, as well as real estate stocks, including the REITs. Now, going down the list, we also have Malaysia and ASEAN. Now, the sector composition of the Malaysian equity market is largely tilted towards financials, also known as the bank stocks. And meanwhile, ASEAN also has quite a high dividend yield, given that it is largely made up of high dividend markets, such as Singapore as well as Malaysia. And on the other hand, if we turn our attention towards the bottom of the table, you will find certain markets like the US as well as Korea. So for these markets, they tend to have relatively lower dividend yields. And the main reason for this is because the markets tend to focus more on tech stocks, which pay out little to no dividends. And therefore, if investors want to include this kind of markets into an income portfolio, we believe that it will be very wise for them to consider ETFs with a dividend tilt. So what do I mean by that? ETF with a dividend tilt, they tend to only invest in companies with very high dividend yields or companies with a track record of consistently increasing dividends. So that provides investors with a dedicated exposure to the high-yielding stocks of an equity market. And last but not least, the third as well as the final building block of an income portfolio that we have identified is none other than your dividend stocks. There are companies in specific sectors which have a track record of paying out very consistent or growing dividends to investors. So banks, for example, they have very stable businesses, so this allows them to pay out growing as well as sustainable dividends to their investors. Another example will be REITs. Here in Singapore, REITs, they are required to pay out at least 90% of their income earned as distributions to their unit holders. So with such a high payout ratio, that is also why REITs, they tend to have a much higher dividend yield as compared to other kinds of dividend stocks. However, do note that investments in a single stock, like investing in a single bank or a single REIT, it can be quite volatile as their values, they may fluctuate in response to idiosyncratic risk, which is the risk involving an individual company. So therefore, we believe that investors who want to invest in dividend stocks, we believe that they should consider instruments such as an ETF, which can potentially value add from the perspective of diversification. So now that we have a better understanding of what kind of investments can go into an income portfolio, I think the next question that you'll probably have in mind is, how do I allocate between the different building blocks of fixed income, high dividend equity markets, as well as your dividend stocks? So for this, the rule of thumb is that the portion of your investments that is dedicated towards fixed income versus the riskier equities will largely depend on two things. One will be on your time horizon, and the second will be on your risk tolerance. Now, first, what is time horizon? This can be taken as the amount of time your investments will be held before the money is needed back. So an investor with a longer time horizon, they may feel more comfortable allocating a greater portion of their investment into equities because they can ride through the ups and downs of stock markets. So younger investors, for example, they can invest more aggressively since they have more time to make up for any losses. So in other words, they may want to consider a growth income portfolio. And on the other hand, investors who are getting closer to retirement or already retired, we think that they should invest more conservatively, as they will need to rely on their portfolio to cover for their living expenses in retirement. So therefore, this kind of investors, they may want to consider a conservative income portfolio, which is to put a greater portion of their investments into fixed income. Now, other than time horizon, I also think that investors should consider their risk tolerance. So this refers to the amount of market volatility or loss that you can or are willing to accept. So investors with a very low risk tolerance, they may prefer investments that are able to preserve their capital. So for them, they fit the profile of a conservative investor, putting more into fixed income. And on the other hand, investors with a high risk tolerance, they wouldn't mind sudden losses in order to get higher potential returns over the long run. So for them, they fit the profile of an aggressive investor, allocating more into equities. Now, another component of a very well-constructed income portfolio is actually called the practice of review and rebalance. And we think that this should be done either on a quarterly or a monthly basis. Investors can check to see if there's a need to adjust the portfolio's asset allocation to reflect market views. So taking today's market condition as an example, global bond yields have climbed to levels not seen in more than 1 decade. And with fixed income finally back in favor, providing the potential to deliver attractive yields at low risk, investors may want to consider overweighting their exposure to bonds in their income portfolios. And next, we've also come to rebalancing. Now, rebalancing, this is to bring your portfolio back to its original asset allocation mix. And this is necessary because over time, some of your investments may become out of alignment with your target asset allocation. And this will usually happen because some investments, they tend to grow faster compared to others. And so by rebalancing, you ensure that your portfolio returns to a level that aligns well with your investment horizon as well as your risk tolerance. So for example, let's say you are a moderately conservative investor, which means that stocks and bonds should make up about 30% and 70% of your portfolio respectively. But after a recent stock market increase, stocks, they now actually represent about 50% of your total portfolio value. So when this happens, you either need to sell some of your stocks or buy more bonds in order to bring your portfolio's asset allocation back to the original mix of 30 to 70. So in this way, it also ensures that you'll always be selling high as well as buying low. Now, for the most exciting part, we have here constructed a hypothetical model portfolio based on a moderately conservative risk profile. So that means it's 30% in equities, 70% in fixed income. Because if you are an investor looking for reliable income, then we think that your investment strategy is unlikely to be on the aggressive side. And in this model portfolio, we aim to achieve a 6% yield. Currently, core inflation in Singapore is at about 5%. So a 6% yield on investments sounds quite reasonable as it helps to potentially beat inflation. In the equity portion, we have chosen a total of 4 ETFs, and each of them are given an equal weight of 7.5% in the portfolio. And where possible, we also try to incorporate less US listed ETFs in order to avoid dividend withholding tax. So if you can recall what I shared previously, Singapore and ASEAN, they are examples of markets with relatively high dividend yields. So therefore, in the portfolio, we have included ETFs that track these two markets. And just now, I also briefly mentioned about ETFs with a dividend tilt. And so in this portfolio, we also have an ETF with a dividend tilt that invests in the China stock market. And this particular ETF is able to generate a forward yield of 8.2%. Whereas if you have invested in a generic China or Hong Kong ETF, it is likely that you will get a much lower yield of about 3 to 4%. So ETFs with dividend tilt, they can provide investors with much higher yields due to their focus on high-yielding companies. And lastly, the fourth ETF here also provides us with exposure to dividend stocks. And in this case here, we have a REIT ETF. And nowadays, REITs, they are yielding at about 6%. For some investors, you may find that it's very attractive. But if you think that it's not good enough, then I'll leave it up to you to decide on how much REIT exposure you want in your portfolio. And moving on to the fixed income portion of the portfolio, we have chosen a total of 5 ETFs, and the allocations here, they are based on our FSM managed portfolios, also known as MAPs. So on the safer investment grade side, we have ETFs that provide us with exposure to Singapore bonds as well as Asian bonds. Because I think if you're a Singaporean investor, you do want to include a Singapore bond ETF into your portfolio, as you won't have to worry about currency risk. Now, on the more riskier side, we also have ETFs that provide us with exposure to high-yield bonds as well as emerging market bonds. So this kind of bonds, they tend to carry a lower credit rating, which means that they are relatively of higher risk. And that's why you can also see that these ETFs here, they are able to provide you with relatively higher yields in order to compensate investors for the additional risk. But do also note that the US high-yield bond ETF and the emerging market bond ETF here, they are both listed in the US, so they are subjected to dividend withholding tax. But don't worry, the yields which are listed on the screen here, they are post-tax. But regardless, if you are not comfortable with holding US listed ETFs, feel free to leave them out of your portfolios. But overall, if you use this set of ETFs and follow the allocations stated on the screen, it is estimated that you will be able to generate a yield of 6% on your portfolio. And that is not all. I also want to take this chance to share with you more about some of the ETFs that we have included in our model portfolios. Now, the first ETF that I've highlighted here is called the China AMC Asia USD Investment Grade Bond ETF. So as the name suggests, it provides you with exposure to Asian investment grade bonds. And based on the chart shown on the screen, you can see that the key source of Asian investment grade debt is China. But what is also more important to note is that the majority of the Chinese investment grade issuers, they are your state-owned enterprises, also known as SOEs, whose economic values are being driven by state policy. So in other words, Chinese SOEs, they are very important as they form the backbone of China's economy. And this particular bond market also offers diversification as issuers span across different sectors, including financials, sovereigns, industrial, technology, as well as real estate. So we'll be investing in bonds which are issued by companies such as the Industrial and Commercial Bank of China, also known as ICBC, as well as Sinopec Group and China National Offshore Oil Corporation. So both of these, they are state-owned oil and gas companies. And currently, yields in the bond market, they have reached a high since the GFC. However, we believe that credit fundamentals remain very sound, and Chinese issuers in particular, they are entering the global economic downturn from a position of rating stability. And furthermore, we think that investment-grade bonds, they tend to be less vulnerable to economic downturns due to their higher credit quality, as well as the general flight to safety. And as such, we do not expect the valuations of Asian investment-grade bonds to widen substantially compared to their high-yield counterparts in the event of a recession. And so with yields attractive as well as valuations undemanding, we believe that it will be great for investors to have an exposure to Asian investment-grade bonds through this particular ETF. And this ETF also pays out distributions every quarter. And next, the second ETF that I want to highlight over here is called the Spider Straits Times Index ETF. While this ETF should be familiar to many of you, I suppose, I also do want to emphasize that this is a must-have ETF for local investors looking to build an income portfolio. Now, the Singapore equity market, it offers resilience due to its large exposure to value stocks, which is relatively more defensive. And value stocks, they can typically be found in sectors such as financials and industrials. They tend to do well during periods of high inflation, leading to an outperformance against growth stocks. And as you can see, based on the charts on the screen here, the majority of the STI is being dominated by value in the form of the financial as well as the industrial sectors. And top holdings, they are your three big banks as well as relatively mature companies. And moving forward, we believe that Singapore banks, which form the largest constituents of the STI, are very well placed to benefit from the environment of higher for longer interest rates. And we also believe that the systemic risk from the collapse of SVB is relatively low. For SVB, a large part of their client base is startups, while for the Singapore banks, their customer base is diversified and is supported by very large corporates as well as a very solid retail customer deposits. And we believe that Singapore banks should also remain resilient even if we enter into a recession because they remain very well capitalized. So investors looking for value exposure as well as very solid dividends should consider this ETF for a diversified exposure. And this ETF also pays out distributions on a semi-annual basis. Now, the last ETF that I also want to highlight is called the Premier Dow Jones Emerging Titans 100 ETF. And this ETF stands out from its peers due to its focus on EM ASEAN, which also means that this ETF does not invest in Singapore. So as shown by the charts on the screen, the largest markets in this ETF, they are Indonesia, Thailand, and Malaysia. And on a sectorial level, there's significant exposure to your banks, consumer staples, as well as industrial stocks. So for us, we believe that ASEAN is a very resilient part of Asia, underpinned by a supportive commodities outlook. And over in the longer term, the region is also a key beneficiary of global supply chain reconfigurations amidst the geopolitical tensions between the US and China. And EM ASEAN's young and large population, which is increasingly higher educated, also suggests that this region is very well positioned to take advantage of tech trends that could help to boost economic growth. So investors who want to gain exposure to this high growth region should consider this particular ETF, because unlike typical ASEAN ETFs, the exclusion of Singapore can help Singaporean investors to gain a more balanced exposure across the different ASEAN markets. So essentially, this ETF can act as a complement as to the STI ETF to gain ASEAN exposure. And for this ETF, it also pays out distributions once every year. And so with that, I hope that you have gained some insights on how to create a passive stream of income that can withstand the test of time. So that's all for my sharing for today. Thank you so much for your time and attention.
Okay, so this is a new environment for me. It's not really VUCA, but I've never done a presentation in a cinema, right? I've always been on your side. So VUCA, anyone here has heard of this term before? No? No? Military buffs? Right, so this is a term coined by the US military back in 1987, right? The year my brother was born. I said, yeah, you're born, and then now you see the US military has coined a term specifically for you because you're volatile, you're uncertain, you're complex, and you're ambiguous. He didn't really like the joke. But now it's come back into vogue, right? It was popular sometime in 2002, 2008, and now it's come back again. So the reason why I put this here is, let's see, volatility. Who thinks global markets are volatile at the moment? Anything? Yeah, uncertain, right? Interest rates, are they going up? Are they going down? Are they going sideways? Fed, are they going to pause? Are they going to hike some more? Are they going to reverse direction? We're getting a lot of uncertain signals. Even the best of us, fixed income portfolio managers, professional investors, are not certain, right? There's a lot of information out on Google, on so many platforms, right? I think if you did a poll, you probably get about 50-50. No, so I think it's uncertain. So the picture I chose here is, arrows, right? Pointing left, right. And I think that's what we are seeing. Ambiguity. This is what happens when I go visit my psychiatrist. Right, they ask me to look at a picture like that on the right, and I ask, do I see the bird? Do I see an animal? Do I see, right? So that's ambiguous, right? I think some of us can relate to that, right? What is the macroeconomic outlook for 2023? I think we started well, at least getting from some of the people that I speak to, but now things have changed, right? The picture looks kind of ambiguous, and then complex. Interest rates, how do they relate to inflation? How does the war in Ukraine continue to play out? How does it affect investment decisions globally or in Asia? In Asia, US-China tensions across the Taiwan Straits, you see some pieces of news. Philippines naval vessel almost colliding with Chinese naval vessel. So not just are these macroeconomic financial but geopolitical threats all interwoven. How do they actually play out against each other? I think it's a very complex question, not something that I can answer. So I'll pause here to give you a kind of brief outline of what I will be talking about. So we have established that, well, I'm trying to establish that the market is, well, the environment we are in is a VUCA environment. And from an ETF perspective, so I'm the business development director at Nikko AM. In simple words, if you think about ETFs, my role is to try to get you to think about Nikko AM and vice versa. If you think about Nikko AM, my role is to let you think about ETFs. So we've got 2 ETFs that I'll be touching on today. We do have 6 in Singapore. I do not have time to go through all, but as my title suggests, I want to walk you through how in a VUCA environment, using one very specific case study, I would say, which is the wiping out of the additional tier 1 bonds for Credit Suisse that happened about a month ago, how 2 of our ETFs reacted to this piece of market news. And then you can see, hopefully from that, we can extract how these 2 reacted, how considerations like duration of an ETF bond portfolio, as well as credit quality affects the performance and how these kind of products react to it. And then from there, you can make your own decisions. You can come to your own conclusions, how it would fit into your investment needs, your investment outcomes that you want to see for 2023 and beyond. And then, that's at least a good starting point from there. So let's start from the top right corner. Silicon Valley Bank, I think I heard the previous presenter talking about that, right? Signature Bank collapse, fears of a repeat of the 2008 crisis. Aggressive central bank tightening, that's happened already last year. Now I guess the question is it going to continue? Is it going to reverse? Is it going to pause? Credit Suisse collapse, that's the case in point that I will be going through in a bit more detail. Energy crisis, really, I think driven by the Ukraine war. Recession risks, that's overarching. High inflation, COVID-19, US-China tensions, and rising protectionism. And at the end of it, climate change. So this was sometime last year, last month. No, wait, we're in May already, so it's 2 months ago, right? Any one of you held Credit Suisse AT1 bonds? No? I guess. Okay, no is good because it got wiped out. So you can see even the FT, usually the more proper state kind of publications, they decided to draw a very big cartoonish headline here. It goes boom, right? And it says Credit Suisse AT1s vaporized. And then in Asia, shortly after that, one day after that, another article, Asian investors got smacked by 17 billion Credit Suisse bond wipeout. The immediate implications were, for me as the ETF Business Development Director, how did that impact your bond ETFs? And I'll go through that later. Right, but this is how I'm going to try to use the VUCA environment, a specific point in time, to see how our bond ETFs reacted. This is a simplified hierarchy of claim priorities. That means if I was a bank and I was borrowing money from investors, and if the bank went belly up, if it went boom, end of the show, it would go in terms of priorities to what is left, to what the bank owes you. Depositors should always be ranked the highest. And then all the way down would be common equity, that means equity holders of the bank. Why this case was so special was because FINMA, so the Swiss regulator, through an examination of the bond details or the bond credentials, right, decided that actually in this very specific case, right, the additional tier 1 creditors would actually rank behind equity holders, which that whole scenario is still playing out. But this is special because in normal terms, if this hierarchy of claim priorities had been maintained, your AT1 bonds would not have been wiped out. The reason why this is such a big deal and why we're talking about it and why people are questioning us at Nikko AM, what's the impact on our bond ETFs, it's really because the last 2 additional tier 1 creditors, AT1 creditors, and common equity tier 1 holders, it flipped. And then people holding the bonds also flip table. right? So jokes aside, because it was such a devastating blow to AT1 holders of Credit Suisse bonds, right? Immediately, or kind of almost immediately, you can see the dates here, March 23, March 22. What happened was regulators globally reacted and said, okay, we know what happened to Credit Suisse bonds in Switzerland. We know that AT1 holders were, in terms of claim priority, they were moved behind common equity. So what they came and they said was, for example, MS, they said that equity holders will bear losses before holders of AT1 bonds, right? Other European bank supervisors step in. So that's the Bank of America, Bank of England, for example, and Hong Kong also came up with the same thing, saying that this simplified hierarchy of claim priorities would be maintained if a similar situation happened for our country's bonds, so Singapore bank equity bonds. So how did the markets react? So I extracted, Bloomberg has got this global index of contingent convertible bonds or COCO bonds, which are essentially the same as the AT1 bonds. You can see that when news hit, the Credit Suisse AT1 debt was wiped out, you can see that the entire index fell, right? From about 130 levels to about 115 thereabouts. But where we are today, when we cut the data as of last week, 26th April, you can see there's more or less recovered back to pre-Credit Suisse AT1 levels. Okay, so there is resilience still in this particular sector, particular borrowing segment of bonds, right? So it has recovered, even though there was a lot of panic at the beginning. So bonds have obviously been in the spotlight even this year, even before the Credit Suisse situation happened. And this is just extracting from Citywire Asia, right? What they do is, I think they interview, well, they get a survey of professional bond managers, right? And this year, obviously, they're bearish, which explains the bear over there. And bond allocations by professional managers are actually the highest since 2009. Anyone remembers what happened in 2008, 2009? No? Everyone was too young? Sorry. Okay, so that was the whole Lehman Brothers Bear Stearns crisis, right? And usually, as we know it in most of our textbooks, is that during times of financial crisis, during times of uncertainty, ambiguity, complexity, volatility, VUCA once again, as evidenced by 2008 and what happened in 2009, bonds generally tend to outperform because there's this phenomenon called flight to safety, right? People use bonds as a volatility dampener, okay? And it seems like, I think there are fears that this year could be the same. So once again, if you recall my previous slide on the entire world map, there's the fears that, it seems to be pointing that there are fears that 2008, 2009 could happen again. And fixed income managers are reacting accordingly. And that's why they asked me to talk about bond ETFs today. Now I moved back a bit to macroeconomic factors. What do we look at if we want to see the health of the economy? The PMI, Global Purchasing Managers Index. So in simplified terms, if PMI is above 50, that means it's expansionary, right? Purchasing managers are looking forward and they're saying, we will be buying more in very simple terms. If it's less than 50, it means that there could be recessionary pressures. They're not so confident about purchasing as much capital, for example, or assets going into the future. To make it easy to see, if it's in blue, if the lines are in blue, it means that it's in positive territory or above 50. If it's in the red line, in the red zone, that means it's pointing towards slowing growth, right? And as you can see, the two dark blue lines, which is the US and Eurozone PMI index, it's below 50. China was positive the last couple of months, but now it's just dipped again below 50. Singapore, for some reason, it's up above 50. Okay. And this, another indicator, another red flag, if you like to call it, right? Data points that investors do look out for when looking at the health of the economy, or whether there would be any signs of recession coming in, right? That's again one of the flashpoints, right? Is there going to be a recession? We look at the difference between the US 10-year and 2-year yields, right? Over here it says that US yield curve tends to invert prior to recession. That means when shorter US government bond yields are actually higher than the longer term US government bond yields. By right, or usually in most circumstances, it is not the case. But when things flip, once again, if you think, when there's a flipping table, when things flip, people get nervous, right? It should not be the case. And historically, we have seen when this phenomenon occurs, 2-year yields are above 10-year yields, that is usually a sign, or market watchers would take that as a sign that there may be a soft patch ahead. So now that we've seen what the red flags are, what the potential red flags are, right, in the macroeconomy, looking at PMI, looking at the inverted yield curve, we look at the asset class. Why bonds? Why professional managers saying that bond allocations are up this year, right? I tried to boil it down just to 3 simple things. Income generation, because bonds, because of the coupons, you do get coupon distributions, usually semi-annually, right? So you would always get some kind of income sustainably and consistently. And that could be a hedge against inflation, for example. At least you do get some kind of returns back on a constant basis, right? You know that you're going to be getting your coupon payments all the way until the end. When the bond matures, you get back principal. Portfolio protection. This really comes because of the inverse relationship between traditionally inverse relationship between equities and bonds. There is a negative or low correlation between performance of equities and bonds, right? So you may be able to take some equity volatility in your portfolio, but some people, if you are a bit more defensive, you may want to look at bonds, right? Not just for the income generation that you get, but also to sort of like lower your volatility of your entire portfolio. And lastly, diversification. Once again, because of the low correlation to equities, that's really what you're diversifying your portfolio against. So this was just a very simple example, right, of what a defensive portfolio would look like if you think that's going to be a soft patch ahead. Right? You can look at many other indicators. I just shared 2 earlier, but you can see that fixed income allocation is about 50%, 40% equity, 10% cash. Right, and really 10% cash is really to help you get to be a bit more tactical. So in case of any dislocations to the market, you actually do have some dry powder to spare. But really, fixed income, this is where I want to focus on. Fixed income is still a very large portion of a typical defensive portfolio. So now it comes back closer to my home, right? Nikko AM. And the Sing dollar bond complex. So we have, in general, if you see the 4 circles there, Nikko AM and our ETFs, our products, cover 2 of those circles, the blue one and the brown one. So how you read this graph is the more returns you expect to get from your bond investments, if you look to the right, you would see that you are also taking on more risk or volatility. So I'll start with the bottom left-hand corner, Singapore government bonds. That's really the safest corner of the Sing dollar bond universe you can be in. But they're not going to give you much, right? The returns is just going to be really safe, low returns, but you're also not going to take much risk. If you go up the curve, you've got government and quasi-government bonds. So that's Singapore government, quasi-governments, LTA, HDB, Sing Power, for example. Then you move up again, investment grade. So you're taking more risk now. You're taking on what we call credit risk, right? That's where you can see DBS, OCBC, UOB, Temasek, for example, SIA. These are the bonds. These are the issuers that you will be lending to. and all the way to the end, high yield bonds. So that's just the, an understanding of the risk reward relationship for the Singapore context. Now there are two bond ETFs, right? On the left hand side, the ABF Singapore Bond Fund, which tracks the iBoxx ABF Singapore Bond Index. And we look at the issuers inside, almost 80% of it is the government of Singapore. So the really safest, right? If you're looking at AAA rated by all three credit rating agencies, you're not going to find many out there. Singapore has maintained its AAA rating for, well, a good long time. For as long as I can remember, they have always been AAA. Any threat to their status as a AAA rated borrower has never materialized, right? And that is always interesting because when there's volatility, there's uncertainty, remember, flight to safety, investors do think about the Singapore government bonds, right? Do think about this part of the market. Now, on the other side, you've got the iBoxx, Sing Dollar Non-Sovereign Large Cap Investment Grade Index. That's the index that the other bond ETF that we have in our suite tracks. You can see that there's still a large proportion, so about 56% of it is still getting exposure to very high rated Singapore credit, meaning Temasek, for example, HDB, LTA, right? If they issue bonds, this ETF would be buying those bonds as part of the ETF's basket of bonds. You've also got banks, real estate, airlines, etc. So credit rating scale, both are safely within the investment grade complex. So all the way to the top, AAA, that's the highest tier. And then on average, the investment grade corporate bond ETF, on average, it's single A. So that's still safely within the investment grade tiers. So this is something that I always have to remind myself, right? The price of a bond is always inversely proportionate to the yield. And the sensitivity of that is measured by a measure called duration. Think about it as a swing. Oh, no, not a swing, sorry. As a seesaw, right? If I go up, my friend goes down. So that's really the relationship between yield and price. Where does duration come in then? If I move back, in the middle here, in the two tables, you can see that the weighted average duration of the ABF index is 7.94%. And on the right-hand side, for the investment grade corporate bond index, that's 6.52. If you want to do the maths, if yields go down by 1%, and the entire portfolio of bonds, the duration on average, weighted average is 7.94, that means price goes up by 7.94%. Sounds good, isn't it? Yields go down, right? If we're thinking that, okay, inflation is under control, central banks will stop increasing the rate hikes, etc., etc., we are seeing a reversal. Yields come down, prices will go up by 8%. But that also means that the risk you're looking at is inversely. So if yields continue to go up by 1%, price goes down by 7.94%. But if you want to do something a bit less risky in terms of duration risk, right? That's where the investment grade corporate bond ETF comes in, 6.52. So yields go up or down by 1%, your prices go up or down at a lesser degree, lesser sensitivity to yield movements, right? At a factor of 6.52. So why is this interesting at this point of time? Why are we talking about it today? Because the top graph here, that's the ABF Singapore Bond Index. Historically, and we stretch history back to 10 years, at 2.84 is still higher than a great portion of this entire history of this bond index. So it is still attractive. It has come off its highs. It was almost as high as 3.5, 3.6%. But at 2.84, you can see just by the line there, it's still above average. It's still quite attractive yields. If you're not invested, in the bond complex at the moment, this could be a attractive entry point from a historical perspective. Moving down to the graph below, you can see that once again, 2019, 2020, 2020, what happened? COVID, right? How did bonds react? So equity markets were obviously not doing well, but you can see that the ABF, right, the safe haven asset class, did its job. It did well, right? 5.1% returns on a calendar year basis, in 2019. 2020 was even better. So that's when we were in the midst of COVID, when all of us were in lockdown, 8.5% returns on a calendar year. That story changed in 2021 and 2022 because what happened then? Inflation started to rear its head, central banks started to tighten, interest rates started to go down, no, interest rates started to go up, bond prices go down by a factor of what do we see? 7.948%. So that explains the returns there. But this year, is the story changing? That's still up for grabs. That's a crystal ball I do not have insights to. But by looking at the year-to-date returns, it's up 2.7%. Okay, this is I'll skip through because I'm running out of time. But this is really coming back to a balancer, right? Why are we looking at bonds? Because it's providing some kind of diversification from equity. Okay, similar story for the investment grade corporate bond ETF. Did well for 2019, did well for 2020, did badly for the COVID years, post-COVID years, especially when inflation and interest rates started to go up. But this year, year to date, it's up 3.5%. And once again, if you look at the graph on the top, 4.24, that's a credible yield from a historical perspective, all the way up to 10 years, right? To lock in these kind of yields at 4.24% for the investment grade corporate bond ETF. And there is a possibility, and I stress there is a possibility that if yields come down, if that is a trend that we're going to see later on this year, if yields come down, you do have the potential for capital gains. You've already locked in a yield at 4.24% on an index basis, right? There is some benefits of capital gains if you invest at this point. So this is, remember the earlier graph, risk and rewards ratio? This is really, if you think about it, as the Fed that you get if you invest in the corporate bond complex over the risk-free, the Singapore government bonds, right? On average, looking at this chart, you're getting about 150 to about 100 basis points spread over the risk-free rate or over similarly rated government bonds. So what does this mean? In the animal kingdom, if you've got some fat, right, what does it do? It protects you from, well, if you're a polar bear, it protects you from the cold. If you're a pig, it protects you from the tiger, right? Did I get the analogy correct? Okay, I'll try. But this essentially, if you are investing into the corporate bond complex, you're taking on credit risk. It just means that you're getting a little bit more protection in case of any movements in your yields, which could impact your price. And as you can see, that once again, if we draw back the data all the way back to, right, more than 10 years, right, 2012, I think, no. Well, I think we've got data all the way, but it gives you about 150, there's 1.5% more yield that you're getting just because you're taking on a little bit more risk, but you're still taking on very good credit risk. You're still getting, on average, A-rated credit risk. Now I'm coming to the end. We're looking back at how has this ETF, right, how has it been impacted by the AT1 saga? You can see that only 11% of the bond of this ETF was exposed to AT1 paper, but not European or Credit Suisse AT1 paper. It's all only Singapore banks. There is some exposure to Tier 2, 13%, but also once again, not Credit Suisse. So still relatively safe. Or at least the impact isn't that wide, right? And if we look at how the entire market reacted in terms of spreads, these AT1 papers were impacted or widened after the whole saga. You can see that compared to the other countries, Singapore AT1 papers only widened by about 55 basis points. But here is where it gets a little bit tricky. And this is where, I think this is a very good slide, where it shows that the ABF actually outperformed the investment grade corporate bond ETF because as a result of what was happening in terms of market sentiment around AT1 bonds at the point of time, in March specifically. Because once again, flight to safety. If you're not certain what would happen to the AT1 paper, there was no certainty that it would recover back to pre-Credit Suisse levels. right? We saw that already happen. There was a panic, it went down, but it recovered again. But back in March, there was no certainty. So you can see that the ABF, which is the super, AAA rated bonds, did well. Because once again, flight to safety, right? Because there was some fear around contagion, what could happen to all AT1 papers, not just European or Credit Suisse papers, maybe even DBS or UOB AT1 papers. You can see that there is a underperformance versus the ABF. So therefore, in summary, so if you're a Singapore investor, Singapore dollar denominated investment grade bonds will, number one, provide you diversification, greater certainty of income. Okay, so in both charts earlier, interest rates have significantly adjusted from historical levels. They were pretty low, but that's over. So from a historical perspective, it is currently at an attractive level. Number two, we're talking about the Fed here. So corporate bonds, and we're talking about investment grade bonds, provides additional, relatively stable credit spreads of, once again, 100 basis points, 150 basis points to help you offset any impacts of rising interest rates if that continues to happen this year. And lastly, ABF, flight to safety, safe haven assets, right? These are terms that we continue to throw out. Government bonds perform best when there's a risk-off market environment. We saw that during COVID. It did what it was intended to do. If equity markets suffer this volatility, VUCA environment, it does what it is meant to do. Flight to safety asset, safe haven, it performs well. It performs best when it's a risk-off market environment. Interest rates are rising, but inversely, it is also weak when interest rates are rising during economic recoveries or when inflation is high. That's all I have in terms of sharing. The rest of it, these are just normal information you can find on our fact sheets. I hope that at least today there's a lot of ground to cover, but at least I tried to establish that in volatile, uncertain environments, there are safe haven assets that you can look at to try to tide you over. Why? Because income generation, diversification, some kind of protection. And then of the two, one reacted better for various reasons, either duration or credit risk than the other, right? So there's a lot of room to cover, but I'm still outside, my team is still outside, and we can answer any questions you might have. But at least this gives you an insight of how different fixed income strategies can help you, answer some of the really difficult questions when it comes to investing in 2023. Thank you very much.
Good afternoon, everyone. So thanks for attending this session. So topic today is riding the reopening wave with the S-REITs leaders. Actually, we have made this call since late last year. So now it's a good time to check whether how it goes and the potential impact of the Fed fund rates continuing hike. So if you look at this page, actually, we still believe investors should turn to S-REITs for growth. This is because the Singapore's reopening is the key to returning to growth. But comparatively, the US and Europe economies are still fighting with the potential growth slowdown, but with the elevated inflation. So my presentation will divide into three parts. The first one will be why S-REITs, and followed by the market outlook and why investors should consider a diversification in S-REIT leaders' names under a ETF vehicle. So first of all, why S-REITs? I think most of you are quite familiar with this concept. We still think the S-REITs is very attractive due to its dividend yield as well as its inflation hedge features. This is particularly true if let's say the Singapore inflation is going to peak soon. If we jump to this page, as shown on the left-hand side, you can see here, the S-REIT, its dividend yield is actually higher. It's nearly 6% now. It's higher than the Singapore core inflation rate and also higher than the STI dividend yield, as well as the SGD deposit rate, as well as the Singapore 10-year bond yield. And more importantly, if you look at the chart on the right-hand side, it not only has a higher yield versus the Singapore major asset classes, but also has a higher yield than their REITs peers, for example, in the peers, the REITs in the Asia-Pac region, and also the Asia-Pac equities. And it also has a relatively lower volatility if you look at the left hand the bottom, the vertical, the horizontal axis, which means if we combine this relatively high yield versus a relatively low volatility, this is actually translates into a high return risk ratio. And if we consider the potential inflation change in the next couple of years, I think these the relatively high yield of the S-REITs is more valuable because in the next couple of years, the Singapore inflation is expected to slow, but the S-REITs yield is expected to remain stable or even slightly higher. So it definitely can act as a very good hedge versus the inflation for now. And this stable dividend yield also contribute to the S-REIT's outperformance in the history. And if you look at the top line, actually over the past nearly 7 years, the S-REIT leaders, they have average annualized return of 6.4% in SGD. And if you look at the chart here, even we compare this S-REIT performance versus their major global US and APAC REITs peers as measured by US dollar performance, it also has had the best performance in the history. And even during the market stress times, for example, since starting from the November 2021, which is also the time when we launched our S-REIT ETF, we can see the S-REIT actually outperform the US stocks, both the value stocks and growth stocks, including the S&P or the Nasdaq. And it's also outperformed the US nominal bonds, the US Treasury bonds, as well as the US inflation-linked bonds, and even the Hong Kong's Hang Seng Index in terms of the US dollar performance. I think the reason behind is quite straightforward, because S-REIT is always treated as an asset class between the bond and equities. So as compared to the bonds, it does has a growth component because it has a rental income from time to time. But as compared to an equity, it also provides a less volatility because typically it has a longer WALE, which is the weighted average length expiry. That's why it looks more aggressive versus the bonds, but more defensive versus the equities. That's why they can balance these two, the risk and return, and achieve a outperformance over time. Even market has experienced a downturn. And in the second part, we'll start from a macro outlook because investors now are still concerning, say, about the elevated inflation, the monetary tightening, and the recession risk. So we'll discuss all of this in details and see whether these factors are actually applicable to the to S-REITs. And starting from these slides, I think at least one of the good news for now is that the inflation is peaking in most of the major developed markets. I think obviously it's a positive sign. And also the Singapore inflation also follow a very similar trend, also start to peak. I think the potential peak of the inflation, they have two implications here. It not only means the S-REITs may have a potential lower operational cost, let's say in the next couple of quarters, but also means the interest rate is also may need to go, is going to peak. And if you look at this slide, let's show on the left-hand side, the time series, both the long-term and short-term U.S. Treasury yields, they already shows some signs of the peaking of the interest rate. And this also echoed by the U.S. Treasury yield curve. It's quite flat or even inverted, which means we perhaps already after the most recent fund rate hike, let's say on the May 4th, we perhaps is already these most aggressive rate hikes is coming to an end. And another positive sign is that the Singapore rate is already peaking even below the US interest rates. I think here the implication is that as compared to the US rates, the S rates obviously has less pressure because their interest cost is lower than US rates, but the yield is still relatively higher than the US rates. And let's suppose the Fed finally already decide to take a pause. And historically, S-REITs actually benefit a lot from this potential peak of the interest rate, because based on the historical experience, the S-REITs, the absolute return for the S-REITs is nearly 20% during the period 6 months to 12 months after the Fed Fed take a pause. And additionally, if some investors decide to move in advance, let's say a couple of weeks or a couple of months or up to 2 months ahead of the Fed pause, actually investor, at least in the history, they may had another 200 bips or 2% outperformance in addition to this 20% total return. So from this perspective, we are quite constructive on S-REIT performance on the back of a potential peak of the REIT or even the lower interest rate, let's say later this year or early next year. And the investor may have another concern about the growth because this year, obviously, the growth across the globe may be slower than last year. But if we specifically talk about the Asia or Singapore growth, which the S-REITs has the largest or dominant exposure, actually, they still quite resilient because the Asia growth is expected to be around 5%, and Singapore growth expected to be 2%. So from this perspective, their growth still remain relatively insulated. So from this perspective, the S-REIT may still get some fundamental support. And valuation-wise, I have to say the yield spread, as shown on the left-hand side, the 300 bips spread is not that attractive, but also fair enough as compared to history level because now the risk-free rate is still at a relatively high level. But PB, the price to book level, are still below 1. I think it still shows some attractiveness in terms of the inflation. And more importantly, with the inflation at current levels, we still believe the gross yield is still the better metric. For example, if you talk about a 5% core inflation, at least the S-REIT has a nearly 6% dividend yield, so still can outperform their inflation. But comparatively with the US REITs, which offer a, let's say, about 4% yield, obviously they cannot beat their US inflation. That's why we think the S-REITs are still attractive from this angle. And fundamental-wise, again, the employment is in Singapore is still quite strong. It's even lower than the pre-COVID level. So even we are talking about the GDP just expand 0.1%, but from a job market perspective, the fundamental support are still there, and it's also worth to note that the Singapore households are still very healthy. The average net assets, it's quite impressive at 2.25 million per capita. I think obviously dragged up by some rich people, but the average number is still impressive, and the average the asset or liability to asset ratio is also quite low. It's just 13%. So if we read from here, I think from this perspective, we still can expect some improvement in terms of the consumption. And again, we already seen the first round of the rebound in terms of the tourists, maybe since late last year or early this year. I think now we should rely more on the China's tourists. If they can return to Singapore, then we can see more boost to the Singapore REITs, in particular for the retail REITs and also the hospitality REITs. And the population growth in Singapore, although at a small absolute level, but still contributed to the Singapore long-term growth more from a structural perspective. And in this section, we'll talk more about the sector outlook. We still believe the reopening theme are in place, but investors should balance between the defensive and cyclical names. And the first one is the industry REITs. If you look back the last year number, the warehouses and factory rents grew relatively steadily, but we have to admit that some leading indicators are already weakening. For example, the Nordics already weakening, so which means the growth may be slower or confirmed to be slower than last year. But good news for the industrial REITs that the long-term investment demand committed will support the demand for the industrial REITs. As shown here is that the for example, the positive change in the manufacturing and also the construction employment, and also the committed FAI will also support the industrial REITs. And again, even we talk about this potential slower growth, as industrial REITs, they provide some defensive features. For example, 8 out of the top 10 pharmaceutical companies have facilities in Singapore. So despite the slower growth, the industrial REITs should stay resilient this year for the Singapore, particularly for the Singapore REITs. And again, the supply dynamics also quite okay because they largely pre-committed, so supporting the future rental growth. And moving to office REITs, I have to say Grade A rental growth may slow this year as demand normalized from last year levels. But the good news that the potential vacancies left by the tech firms may be refilled by the other types of firms. For example, the non-bank financial sectors and also some legal and tax advisory and insurance houses, as well as the fast-moving consumer good companies. So the supply and demand should still be quite balanced, and occupancy, as shown on the right-hand side, is still high at nearly 95%. And the below 10-year average office supply may also support the CBD office rent this year. And retail REITs is quite straightforward because consumption is anticipated to remain supportive. And if we combine this with a limited new upcoming supply, this will also support it to the rents for the retail rent rates. And the improving visitor arrivals, as I mentioned before, so will also support the retail REITs performance. And someone may be worried about the online sales, but I don't think it's a problem in Singapore because the shopping malls here is not only a shopping place, but also a place for dining, entertainment, or kids' playground, or even the aircon. So obviously, it's not an issue for Singapore REITs. And hotel REITs, again, if it's we see more tourists from China or from elsewhere in the world, and it's also if you also take consideration of the potential limited new supply, new hotels, then obviously the RevPAR growth will be still getting some support. And in the interest of time, I will move into the last section because we'll tell you why an investor should also consider a diversified portfolio in the SGX issued iEdge Leaders Index. I will not go through every single detail, but I want to highlight 3 key features. First one, these leader index, their minimum market value threshold and minimum liquidity threshold can ensure the index only includes the large and mid-cap names. And secondly, their liquidity-based weightings can always help the portfolio capture the hottest investment market themes. For example, after the March rebalancing this year, we increased the weighting to the more defensive industrial logistic REITs, but followed by the office and retail REITs. And thirdly, if you look at the pie chart on the bottom right-hand side chart, you can see even investors invest in S-REITs only. Their geopolitical exposures will be in APAC or even globally. So from this perspective, investors may still enjoy a tax benefit, but with the exposure to the international REITs. And large and mid-cap S-REITs obviously has a scale advantage because they can acquire good quality properties, and with creating a bigger market cap and more stock liquidity. This will translate to higher stock valuations and help them to raise equity and acquire more projects. And that's why the large and mid-cap S-REITs outperform their smaller peers in the history. And also, it's worth to note that most of the large and mid-cap S-REITs, their sponsor have a government linkage, for example, the Temasek. So different from a lot of US REITs, they have a very strong funding channel and more stable funding channel. And that's why they are little impacted by the most recent, let's say, US or even the Europe banking crisis. And investors may ask if S-REITs is so attractive, why don't we buy the S-REITs directly instead of buying a versus buying an ETF. I think these tell you one of the key reasons, because buying the ETF, they may potentially save the cost, because much lower beta spread versus directly buying the underlying S-REITs. And also the ETF manager can also leverage our scale and network to lower the cost for investors and transfer these savings directly to the end investors. And this one will jump to this one. And this diversification advantage is quite obvious. It's reflected in the lower volatility versus directly holding the underlying names, and potential lower drawdown versus holding the single names. That's why we need a ETF vehicles. And here, as compared to directly holding the property and the individual S-REIT, we still believe holding an S-REIT ETF, they have a much lower entry threshold, slightly below the $1, but also has a potential lower trading cost, lower beta spread, but with a higher diversification arrangement, but also with a high transparency. And now it provides a relatively stable yield, nearly 6%, which is 5.8%, but investors still are tax exempt, particularly for the dividend income for the individual investors. And this is a snapshot of our S-REIT Leaders Index ETF. We have AUM at SGD 19 million, and we have two counters listed on SGX. One is SRT in SGD, and the other one is SRU in US dollar. So investors can easily trade them on SGX with only starting from 1 unit only, or slightly below $1. And if investor wants to create shares, let's say 50,000 units, it's also okay. It's just like a creative mutual fund shares. And the distribution policy is semi-annually. Our policies here is that we will pay out all of our underlying dividend received. But if this dividend yield is lower than, let's say, the benchmark yield, we may also adjust up this dividend yield to be in line with the index yield. So the investors will guarantee the investors to get the yields they expect. And now the management fee is capped at 60 bips, which means that regardless of the ETF size, the ETF, the management, the fee will be capped at this level. And now the performance year to date quite strong. The absolute performance is more than 5%, and also outperform the benchmark by more than 30 bips even after the TER. And since inception, we outperformed the benchmark by 5 bips after the 6 bips fees, which means if you're adding back these the TER, we actually outperform the benchmark by 65 bips. So that's why investors can compensate by the lower trading cost, and also their TER fees will be offset by these outperformance, at least based on the current track record. And in summary, I think as compared to the holding a single S-REIT or directly holding the property, we believe the holding an S-REIT ETF will provide investor more stable dividend return and also more diversification. But investors can also enjoy a potential lower tax or the tax benefit, and also the lower liquidity trading cost. So this concludes my presentation. Thanks.
Okay, good afternoon, ladies and gentlemen. Let me just start. So basically, over the next 20 minutes, I'll try to basically, touch on the key points so that you all can decide whether or not there's future investing in Chinese equities. But before I go into the proper presentation, I just want to maybe, touch on give me maybe 2 minutes to touch on a bit on geopolitics, especially when it comes to investing in Chinese equities right now. You have to also consider geopolitics. And in geopolitics, I just want to highlight to everyone is that there's actually no right or wrong. There's no such thing as divine or evil. Countries, the presidents or the prime minister, the leaders of the countries basically will act in the interests of their people. So, in a democratic countries like Singapore, for example, leaders are selected, elected, and they basically, will act in the interests of the people. So in the case of what we term as authoritarian or communist system, the leaders are selected. And therefore, you have to understand all this. There's actually nothing wrong between, democratic society or communist society systems. See, ultimately, all these leaders are to act in the interests of the people. So, as you're probably aware, is that, between US and China right now is a struggle of superpowers. And unfortunately, I think in Singapore, we are also, we noticed, and also because of our educational background, we use English as our primary language. And therefore, along the way is that you will be subjected to what I believe as the influence of Western media. And you all should know that of late, especially over the last 3-5 years, the Western media has been very critical of China and the development in China. So again, these are the backdrop so that as I go through this, you all can at least understand. So what you see here is the chart. Basically, China had a fairly strong, I think, very strong years even during the COVID period. If the Western media is to say is that China probably underreported their number of deaths. But what happens here is that what I believe, if you look at all the data available, is that actually China has actually managed the COVID crisis pretty well. But what happened last year was that China decided to sacrifice its economy to save people, and therefore had implemented what we term as lockdowns that is actually very surprised. Lockdowns in Shanghai, in Shenzhen, that actually caused the economy to be slower. So last year, China only grew 3%. The year before that was 8.4%. So along the way, the Chinese market, as you can see on the chart, rose back in 2020. But in 2021, what also happened was that, they did what we term as, they call it a drive towards common prosperity. And they had a bit of regulatory crackdown against very large mega cap e-commerce companies. But nevertheless, what happened is that, since then, I think especially last year, things were not turning out to be very good for China. But then what happened is that as we look forward for this year was that this is the reopening that we all has been anxiously waiting. I think Singapore has reopened for business. Life is back to normal. We don't really need to wear masks. Even you contracted COVID, you just rest for a week and then you recover again. But the case here is that I think when China reopens, it's a very big thing. And therefore, if you look on the chart here, is that they actually recovered pretty strongly as the whole world anticipate China to recover economically. But however, due to the balloon incident back at the end of, at the beginning of February, so things turned to be very negative again. And all this negativity is due to, if all this Western media narrative that China basically sent a spy balloon to spy on US. So again, these are all politics, whether is it a spy balloon, weather balloon, actually doesn't matter right now because, the point is that if USA is a spy balloon, meaning that, investors will feel a bit of tension between the two countries going forward. Okay, maybe I should tell you the key thing about this recovery is that I think things are actually turning pretty well for China economically. If you look at some of the reports during their May Day Golden Week holidays, you can see that it was reported that 240 million people actually travel internally. You imagine 240 million, I think Singapore is only what, 5-6 million. When 240 million travel internally, you know, and each of them spend what, $100 over 5 days, which is a very small amount. You know, we are talking about $24 billion. So you say 100 is not enough, spend 200. So we are talking about almost like $50 billion over the, you know, the Golden Week holidays in China. So again, you know, this year, while the global economy, as you probably had some sessions before this, is that the external demand are likely to be weak. You know, like Singapore NODX is falling. It symbolizes the external demand because of very sharp slowdown in US, in Europe. Therefore, exports are likely to be negatively impacted. And therefore, you have to basically rely on certain things like, for example, your own domestic demand. So in this case, China is pretty strong in this area. So yeah, I mean, the point here is that we also show you the PMI. You know, there's a big recovery and basically led by what we term as the non-manufacturing PMI, which is the service PMI. The service PMI basically means that you must understand that last year on a low base comparison, you know, China was subjected to a lot of lockdowns. This year, there's nothing. You know, you are free to go, life is back to normal, and then you have all this revenge kind of spending. And therefore, you can see that, you know, China is clearly turning around. You know, although, again, I want to highlight to you all is that just look at the data. Don't be affected by news flow to say that, you know, China's growth is not that strong or weak. Okay, the government actually came out to give their guidance that GDP growth will be like around 5%. By the way, you know, Goldman Sachs reported that, you know, anticipate that the growth is likely to be around 6% for 2023. China grew 4.5% Q1, okay? In order that China at least reach 6%, Q2, Q3 are likely to be even more than 5%. Else they cannot reach their minimum target 5%. And 5% is just the government's target. You know, there are other economies worldwide are actually raising a higher number. Of course, at the backdrop, you also have to understand that this year, you know, Europe is likely to go into a recession. You know, and you know that US Fed has increased interest rates to what, 5.25? With higher interest rates, surely there will be economic slowdown. You know, so it's inevitable. And therefore, you have to basically understand, you know, for China going to this year, they have to depend a lot more on domestic consumption. Of course, here is that, you know, this is really geopolitics, is that why investors are also concerned in the case that, you know, this US-China tech war, this is following the, you know, US-China trade war back in 2018. In the trade war, I can highlight to everyone is that China actually is winning in terms of the trade war. Why? Because China's, if you look at the last year's trade numbers between US and China alone, you know, it was a record trade numbers, exports for China, trade deficits between US and China. So therefore, even despite the tariff, you know, where I think importers have to import and pay tariff around 20 to 30%. But so despite that, you know, China is still able to sell a lot more goods to the US. However, given that, you know, given that US need to understand that in order to suppress China from growing even further, you know, they have to come up with certain things to basically suppress China. And, you know, maybe I want to give example. I think maybe some of you are born during that time, is that during the 1980s, 1985, Japan was supposed to be a very strong economy. If you all know, you know, Japan, you know, the likes of your all the Japan corporates, they are very strong in semiconductors. Their automobiles are also very strong. Your Toyota, your Toyota, your Mazda, for example. Your semiconductor is your Toshiba, Hitachi. Even Sony at that time was a very strong, consumer electronics. But in 1985, if you all can read up also, is that US actually activated or implemented what we term as a semiconductor constraint on Japanese product. And therefore, and also with the Plaza Accord back in 1986 was that they raised they appreciate the currency of Japanese yen, make it very uncompetitive for Japanese export. And therefore, the Japan economy since then, of course there were other problems thereafter, but since then have 20 years of, basically, what we term as the lost 20 decade, sorry, two decade of depression. That is the backdrop. And basically, US is implementing the US Chip Act, US Chip 4 Alliance to basically corner China. Again, it's a lot of things, moving parts, is that China doesn't fear competition. But this is basically not really competition in the sense that, if you look at Intel, Intel can manufacture 7 nanometer advanced chips. SMIC recently announced that they can commercially manufacture 7 nanometer. But the point here is that, US will basically invoke this and basically, ensure that, other players, whether is it Samsung or TSMC, in this case, TSMC already doing 5 nanometer, going to 3 nanometer, are not able to supply advanced chips to China. So in that sense, trying to suppress China. Not only that, is that US also get or ensure that their alliance, in Europe, for example, as ASML, in Netherlands, not to supply lithography machines, to China. So basically, China has to do everything, and need to be very self-reliant on itself at every level of the semiconductor supply chain. And it's going to be of course, a challenging task. I'm not saying that China cannot overcome it, but China needs time to overcome all this, Okay, again here is that a bit of backdrop. Why US is doing this? US is very happy when China just do the normal parts, earn the normal business. China rose, especially after WTO, start to gain a lot of momentum. If you all notice of late is that actually in terms of quality of goods, China is actually getting a lot stronger. It's no longer the weak, no longer doing toys, for example, or make low margins. So Chinese also wants to gain more margin and move up the ladder curve. But what shocked US was that China is doing 5G with Huawei. This high margin business, this is what the Western wants to dominate. Chinese shouldn't be doing all this. Chinese should do the low end stuff. So therefore you have all this problem right now. And the point is that with 5G, 6Gs, and China moving to EVs, AI, quantum computing, that makes US pretty nervous, because we are talking about hegemony status right now. And therefore, this is not like, this situation will go to end in the next 5 years. It's going to be next 5 years, 10 years, Unlike the Western economies, China does not have an inflation problem. So inflation is still pretty benign in China. So, it's again here you have to understand is that while last year reported was that, because of fuel shortage, the high oil price, because of some commodities, for example, inflation shot up the roof, So we are talking about inflation in US now, of course, is coming down, but in Europe, we are talking about high numbers between 6 to 10%. But in China, we are talking about very mild inflation. The last one was just 1.8%. So in that sense is that I felt, and China can actually afford to reduce interest rates or adopt a fairly accommodative, monetary policy. So this is actually a very different from the Western economy. However, of course, here is that I think investors or you all should also read that, China did have some problems because of, some very highly leveraged property developer going into financial difficulties. But what happens last year, back in November, is that the Chinese government actually came up with a 16-point plan to try to at least ensure a soft landing for its property sector. The point here is that, this takes time, because what happens is that there were some issues where some of these home buyer who doesn't want to serve mortgage loans, basically stop paying mortgages. But what happened is that their complaint was that the units wasn't even built or not even building. I won't want to pay for it. See, so the government basically now have to take over the construction part of it, to oversee it, to ensure that all these units are completed, and therefore allows the home buyers to continue service their mortgage loans. And once that is done, I think basically the completion will take at least a year. So we are actually like few months down already, since 6 months already. So maybe by the end of this year, at least some positive sign from there. So bear in mind, unlike the Western economy, China interest rates remains low. So therefore, affordability of home buyer are basically not really affected. So that is the distinction I just want to highlight to everyone. Okay, but since then, if you look at the valuation of China equities, is that, unlike in US or some of the Western economies, Chinese market is still fairly depressed. I will attribute that to what I term as highlighted on the very first few minutes of my presentation, is that there's geopolitics involved. So, the point here is that I think we all can read. I think most of the audience here can read English, can even listen to Chinese, for example. But unfortunately, a lot of Western fund managers only have one channel of news flow, and that's through Western media. And therefore, you can imagine that, their understanding may be also very subjected to all this, news flow. Maybe I just want to highlight to everyone is that let's look at China at itself and what is its strength. If you look at this, what we term as a 1 trillion global economy, China is the second largest as shown in the chart here. But again, I want to highlight to everyone, while China is the second largest economy in the world, is the top exporter and importer of goods. So, the point here I want to highlight here is that the other thing is that, China has the largest middle income consumer market in the world. Why? Just give you an example. How many cars are sold in US? We are talking about 15 million cars a year. But in China, we are talking about 25 million cars a year. So China has actually overtaken in terms of the size of the market. And, a lot of MNCs basically also want to participate and want to do business with China. So we all read on the news media is that, who is visiting, like French president is visiting China. Basically, they just want to do business with China. China has proven capability. And of course, here is that, in terms of, China, okay, I just want to highlight here a bit more, is that, this is going to be a transformation change that all of us should be aware. It's just like your iPhone, your smartphone back in 2006, when feature phones, your Nokia phones, went to smartphones. Where we are going to face a change is all those industrial combustion engine cars. Combustion engine cars will change to what we term as electric vehicle. And what happens here is that China is very dominant in this area. And even the like for example, German automakers wants to partner Chinese Chinese battery makers to do all this, to basically produce electric vehicles. And electric vehicles, over the next, I would say, next 10 years will continue to grow very strongly, at least 30% per year. And what I just want to show you is that China basically had this supply chain, basically covered right from the upstream, from the material segment to making cars. And not only that, if you all think about, we are going green, every government is going green. Again, here is that you all need, or the world need, for example, just in solar cell, they are so dominant. If you look through whether China, they basically produce modules, cells, wafer, polysilicon, just dominated. If you look at the red bars over there, is that China basically dominated in those areas. Of course, we're talking about consumption. We think that over the last 3 years, they basically, they were in lockdowns and they have accumulated a fair amount of savings. They are likely to spend, and what we term as revenge spending, especially in the first few months of this year. And not only that, I think basically in terms of consumption, they are likely to even spend more, local, even for local brands. So these are some things that we look at, when we invest in China. And although this has been highlighted as aging population, I'm sure everyone is getting older, by the way. But the point here is that, this is also a situation, an issue for China. That's why China wants more birth, to ensure that at least the population does not decline. But just to highlight here in terms of healthcare expenditure per capita, China is still one of the lowest. And therefore, it is actually a very good opportunity because these are aging population. You have to spend more to tackle these kind of issues. So with that, I just want to highlight here is that, for example, China A shares. I'm not talking about China H shares. China A shares are the lowest in terms of correlation with other markets. So, therefore, I think the trend here is that at least over the next 2-3 years, China A shares are likely to perform better than China H shares, as the reason I've pointed out. And finally, again, what we term as a China equity discount are likely, because of geopolitical situation. And because the West dominates in terms of global financial markets, therefore, as I highlighted to you, some of the Western media reporting matters more, even though that it may not be factually correct. There again, Chinese economy likely to remain strong into this year. We believe that Chinese equities is attractive, but however, because it has to be traded at a discount, do not expect, like 100%, 200% performance, within a short period of time. China, unfortunately, over the next 5 years, we probably should know by then whether China is going to win or to be the largest economy in the world. Because whatever US is trying to suppress China, it all depends whether China can pull out of it. My belief that there are certain issues, but if China put it that way, China's political system is more stable in the sense that they don't expect Xi Jinping to be away at least over not the next 10 years, but however, the next US presidential election, are likely to be a bit more complicated because you don't know whether Biden will continue in the next term or Donald Trump will come back. And these are political uncertainty even for US. But more specifically, there are actually a lot of companies that are trading at what we term as good valuation. The listing of Alibaba units, are likely to be some of the thematic that could be a catalyst for investors looking back at China again. Right now, China just trades at 10 times PE. This includes the Hong Kong, China stocks. And, we don't expect it to go to 15 times, unfortunately, but ascribe a lower valuation. But that also still means some decent upside. But you must understand, every time there's a big upside, please take profits, because at the end of the day, there will be negative news. And once negative news flows, then investors, it's like the Western news will always highlight the negative things about China. No doubt about that. So even 5% growth is considered, when US is growing 1% or 1.6% max, if China grows at 5%, hey, I'm growing 3 times more. But they say 5% is actually very weak. So, but my understanding is that at least China can grow 6% this year. So I believe that, you still can get some upside from there. But the challenge here is that, if you have a longer term investment horizon, I believe that over the next 5 years, China can actually overcome all this suppression, and China will be the largest economy in the world by 2030. And therefore, if you invest in China equities then, or China A shares, you should get actually pretty decent rewards for the risk that you take. Okay, with that, maybe, I run out of my time. If you all need any questions, I can do it during the later Q&A. If not, you can go to the UB Asset Management booth. I'll be there. We can, basically discuss any issues that you may have. Thank you very much. Thanks.
Thank you, FSM, for inviting me to do today's session. My name is Jermin. I'm the head of SPDR ETFs at State Street Global Advisors. So today I'm going to be talking to you about how to build a strong portfolio with Singapore equities. So for those of you who have not heard of State Street Global Advisors, we're also known as SPDR for short. You perhaps might be more familiar with that name. We run the STI ETF in Singapore. We also run SPDR Gold Shares. I will be doing a brief introduction of my company subsequently. But I'll just get straight to the point. We're all concerned about investment returns. So what would have happened if you had invested $10,000 in the STI 20 years ago? Today it would be $36,000. So 3.6 times. If I were to compare this to, say, CPF OA standard 2.5%, $10,000 after 20 years would be about $16,004. SA 4%, it would be about $21,009. So 36,000 represents a compounded annual growth rate of approximately 6.5, 6.6%. So if you had invested for 20 years, this is what it would be today over time. So never underestimate the power of compounding. And what if you had invested $10,000, but every month you continue to put in money and dollar cost average or via a regular savings plan into the STI? If you had invested $10,000 20 years ago and contributed $1,000 per month for 20 years, today it will be close to $500,000. 480,000. Total amount invested from start to end is about 260, but the amount today would be 480,000. So don't underestimate the power of compounding. It's very powerful. And this is partly why I have been speaking in different capacities on the Straits Times Index for quite a number of years now. And a common feedback that I tend to get from investors is that, hey,
Many years ago, I bought, it was 2,000 something, today still 2,000 something. Or many years ago, I bought, it was 3,000, today still 3,000. Right? But I think investors fail to really comprehend the power of dividend income. And like it or not, STI as an index is made up of predominantly financials and real estate. So we've got the three banks, we've got all the Singapore REITs, and due to the nature of that, it's slightly skewed towards an index which is provides a good income to investors, which is why the dividends is very, very important. So if you look at this chart that I have here, over different periods of time, what we have seen is that dividends have been a significant, but not only significant, it has been a growing source of returns, for dividends accounting for more than 40% of total return since the year 2000. So if you look at the different periods in time, 2001 to 2005, and then 2006 to 2010, 11 to 15, 16 to 20, and then 21 and 22, what you'll see is that the dividend income over every one of these periods is increasing. So it's increasing over time. And I think some of you older or perhaps more sophisticated investors would have heard of the SIMSCI before. So the SIMSCI is the MSCI Singapore. It also tracks a Singapore index, but slightly different from the STI, two different index providers. So if you like growth, what MSCI Singapore had recently done was to include growth stocks like C or Grab into the index. And I'll show you what had happened to the index of MSCI and the difference in performance. So having growth stocks within the index may not necessarily be a good thing, especially in these couple of years where it has been slightly volatile and uncertain. Being boring may not be that such a bad thing. So how do you invest in the STI? You can't invest in an index, right? An index is just a number. You can try and replicate the STI by buying all 30 stocks by yourself, or alternatively, you can use the ETF. So I'm from State Street Global Advisors. We manage the STI ETF in Singapore. Code is ES3. And some of the benefits of ETF, I'm sure this has been covered a lot earlier, but I'll just quickly go through. Low cost, diversification, rebalancing and management for you, as well as income potential. If you're not familiar with State Street Global Advisors, we are the first creator of many of the world's ETFs. We were the first company to launch the first ETF in the US. We launched the first ETF in Singapore. We launched the first ETF in Hong Kong, as well as Australia. So the STI ETF was launched on the Singapore on SGX back in 2002 as the first ETF in Singapore. The STI, this is a sector breakdown. So as you can see, the largest weight in the STI, and I think we all know this, is financials. That's really the three big banks, three big local banks that we have in Singapore: DBS, OCBC, and UOB. They form collectively close to 50% of the index. So a lot of people say, buy the STI, might as well just go and buy the bank stocks. DBS especially is now close to 20%, which within the index is not a bad thing. In fact, Singapore financials has been very resilient, posted strong earnings and very resilient amidst even what's happening in the US and the banking situation in the US. So in comparison, US banks has been down 30% year to date, but Singapore financial stocks have held up quite well. And if you can see, real estate is the second largest component of the STI. I think we're all very familiar with REITs and Singapore REITs. Singapore is quite commonly known as the REIT capital of Asia. Many REITs, even foreign REITs, come to SGX to list. REITs have also been doing all right. There are a lot of subsectors of REITs. We've got retail REITs, commercial, industrial, and of late the industrial REITs have been, I guess, the shining component within REITs because of positive rental reversions. And as you can see, after real estate, we've got utilities, tech, and materials form a very small, more negligible part of the index. Where are we now in valuations? So the price to earnings, or PE ratio, I won't go into detail about what PE ratio is. I'm sure most of you are quite familiar. Is sitting just below the average for the last 30 years. So this can mean that the STI is undervalued. It could also mean that earnings forecasts are not as healthy. But Bloomberg consensus actually expects forward earnings to go up, right? Which kind of tells us that based on the current price to earnings, it might not be a bad time to start buying into the STI ETF. Some product information about the SPDR Straits Times Index ETF. The ticker is ES3. Inception date is 2002. So this was when it was listed on SGX in Singapore. We've got an all-in management cost of 30 basis points. So what does this mean? Different ETFs have got different management fees, and an ETF is a fund. A fund has a various number of different costs and expenses. Management fee is just one of them. There's going to be a trustee fee, there's going to be an audit fee, there are going to be legal fees, custody fees, etc., and it all adds up. So different fund managers, some charge an all-in fee, some you will see all these fees being charged to the fund. Some managers, they cap it off. Different fund managers do it differently. But for State Street Global Advisors, for the STI ETF in particular, 30 basis points is an all-in fee. So if you invest $1,000, you're paying $3 a year in management fee to State Street Global Advisors. And you're never paying it directly. It's deducted off the NAV or the trading price of the fund. So it's never a direct payment. The ETF does make semi-annual distributions twice a year. And the method is full replication. That's also important. I'm sure this has been covered earlier. But basically, what full replication means is that what is in the index, we buy those stocks in the index. We do not use derivatives. We do not use proxy or buy other stocks. The top 5 holdings of the STI, there's DBS Bank, OCBC UOB, that forms the top 3, followed by Singtel and Jardine Matheson. I covered this somewhat earlier. Financials form a very big part of the STI. It's 49%, followed by real estate at 21% and industrials at 14%. Together, these top 3 sectors make up 85% of the ETF. And then relatively smaller weights to traditionally cyclical areas such as infotech and materials. The top 5 companies that I showed earlier, these top 5 companies make up 56% of the index. And as a whole, the STI has got 30 stocks, right? As a whole, these 30 stocks make up over 80% of the entire market cap of SGX. So what this means is that actually buying into the STI, it's really very much the market barometer for the Singapore stock market. If you are positive on Singapore's economic growth, you are positive about Singapore's future, then the STI would be a good investment tool for you to invest in. I mean, of course, there's also the concept of home buyers. I mean, we're all Singaporeans. We're familiar with the local brands. We're familiar with the local banks. We're familiar with Singtel, etc. And the US or Hong Kong or China might be a lot more exciting. But I think there are also benefits of investing and having some form of home buyers. One example could be currency risk. If you're investing in Singapore, it's all Sing dollars. There's limited or very little currency risk. Tax could be another reason. If you're investing in a US listed ETF, there's always going to be withholdings tax on US listed stocks. So it's not necessarily a bad thing sometimes to have a bit of home bias. So I spoke about this earlier, the STI versus MSCI Singapore. So you can see somewhere along the line, the performance started to deviate where STI started to perform much better than MSCI Singapore. And the reason for this was because MSCI Singapore decided to add in a big chunk of the index constituents and weighting to C Limited, as well as Grab. And given the market conditions in the past couple of years, these were not stocks that did very well. As a result, the STI performed much better than MSCI Singapore. So compared to some other Singapore equity ETFs out there, we're not the only one. You can see that the SPDR STI ETF has got the lowest average monthly bid-ask spread. If you're not familiar with what bid-ask spread is, it's the difference between the buy price and the sell price that is on the exchange. So of course, the lower it is, the better. The higher it is when you go in and when you sell and you come out, it's a higher transaction cost. In terms of trading volume, we are one of the STI ETF is one of the ETFs with a largest daily turnover on the SGX. I think consistently top 3 ETFs. So these figures are from April 2021 all the way until March 2022, and then for the calendar year 2022, as you can see, it has remained quite consistent. So the little short bar on the left-hand side of each bar chart, that's the average monthly bid-ask spread of the SPDR STI ETF. So in summary, regular savings can accelerate wealth creation. It's one of the ways in which we always encourage investors to invest in the longer term. I am aware that FSM has got a RSP program on the SPDR STI ETF. So that is one way in which you are able to access via a regular savings plan to dollar cost average. So when sometimes it's high, you buy a bit higher. When it's low, you buy a bit lower. Over the longer term, you will realize that your average price is perhaps quite average, right? So you get access to the longer term returns and growth potential of Singapore. ETFs offer a low-cost, diversified portfolios. I will not elaborate further on this. And the SPDR Straits Times Index ETF, ES3, covers more than 80% of companies on SGX by market capitalization. How to invest? You can buy and sell like shares directly through a stockbroker or a bank or a platform like FSM. You can invest through a regular savings plan, as I mentioned earlier. The STI ETF is also available via the CPFIS OA investment scheme. And it's also available through supplementary retirement scheme. So you can buy using your SRS and your CPF OA money. This brings me to the end of my presentation. Before I end off, we have a booth outside. So if you've got any questions about any of the SPDR products, be it STI ETF or SPDR Gold shares, or we've got other products listed on the SGX as well, please feel free to approach any one of the SPDR sales representatives at the booth later. Thank you very much.
So a very good afternoon to everyone. My name is Chloe and I'm a Senior Research Analyst at IFAS. So thank you for joining us once again for our ETFestival. And today I'll be sharing on a topic which I think is very relatable to everyone here, as it's after all something which is very close to our hearts, or should I say our stomachs. So as you can tell from the title here, I'll be sharing about the whole topic of food as an investment theme, as after all, food security is an issue that has really come under the spotlight in recent times, as rising food prices are actually hitting the pockets of consumers. So essentially, we are entering a real-life Hunger Games where you spend more, but you get less, and this has been the reality for everyone nowadays, with food inflation being so pervasive. And going forward, we have reason to believe that food price inflation is likely to remain sticky. And I'll be actually sharing about some of these reasons in the subsequent parts of the presentation. So over here is the chart of the FAO Food Price Index, and it measures the monthly change in the international prices of a basket of food commodities. So you can see from this chart that although food prices, they have come down from their record highs in early 2022, they continue to remain at rather elevated levels. And consumers are feeling this pinch of higher food prices, and governments also have this urgency to act given how this basic necessity has already left many families struggling to actually feed themselves. So it's no surprise that your domestic food price inflation is actually soaring. And over here I have the food inflation heat map, and it shows this rate of increase above 5% that is actually happening in almost all economies, irregardless of their level of income. So you could say that no one country is being spared from this, though of course it's important to note that there are some countries like Argentina and Turkey who are badly impacted with this food inflation, and it's actually coming in way above 30%. So I say Argentina's food inflation came in at over 100%, while Turkey's food inflation is around 70%. And if you think about that, right, these are pretty mind-blowing figures. While in developed countries, for instance, such as the UK, I think things are not looking much better. So the official figures are showing that your food inflation actually reached 19.1% in March, and this also happens to be a figure that is above UK CPI of 10.1%. And speaking of the UK, preparing a thing such as your English breakfast is now around 23% more expensive than a year ago. So this is just yet another indicator of how this whole cost of living crisis is actually squeezing your household budgets. And back at home in Singapore, food inflation actually remains at 8.1%, and even our beloved hawker centers are no exception to this global inflation fight. And they've posed the largest price jump across all your other dining outlets. So many hawkers, they have no choice, and they have been forced to hike their prices, especially hurting those that belong to a lower income where such food is actually a necessity. And as rising food prices become more of a hot button issue, we're increasingly seeing more articles out there, such as the one below, where people try to find ways to actually cope or deal with these higher food prices. So now you know the secret is out. Please go to the west to enjoy cheaper prata and have kopi in the central. So another example of food inflation back at home is how grocery shopping is so painful, and especially to our wallets. So this is just the main culprits behind it is actually that of your humble chicken egg. So the prices of eggs, I think everyone knows here, they really shot up from 2021 to 2022. And the price chart here is just for 10 eggs. So if you are buying a carton of 30 eggs, which you typically see in the supermarket, you're essentially about multiplying this figure by 3 times. And so all the egg lovers out there, they are really feeling this pinch of your higher egg prices due to the higher chicken feed prices, as well as your logistic costs. And all of these are pushing up prices and onto that of consumers. So not to mention, your egg prices have also gone up due to that of your global bird flu outbreaks. And so much so that your supermarkets such as your Sheng Siong, your NTUC FairPrice, your Giant at one point had to subsidize your egg prices in order to help Singaporeans actually deal with this higher egg costs. So seeing that food price inflation is everywhere, so now let's look at some of the major reasons behind this. So starting from the supply side, I think everyone knows that one of the major reasons that come to mind on why we see such high food prices is that of the Russian-Ukraine war. And while the Russian-Ukraine war has gone on for more than a year now, I think concerns about food security, they still remain. And the issue is not just about your Ukrainian supply, and it's not just about the production, but also about the ability for Ukraine to export their food out. And when it comes to food security, this whole idea of the Black Sea Grain Initiative is something that has to actually be closely monitored. So this is an initiative that is brokered by the UN and was created to ensure a safe transportation of your grain and foodstuff out of Ukraine. And there's always been a lot of uncertainty with regards to this deal, with Russia now threatening to actually pull out of the deal on many multiple occasions. And this latest deal is actually due to expire on 18 May. And Russia, of course, has talks about threats of abandoning this deal beyond this period. And also, the grain use from Ukrainian farms could actually fall and be down by about 50% compared to pre-war. As you know, Ukraine is affected by this war with a lot of disruptions to their whole agriculture sector due to the lack of fertilizers, as well as, of course, the ongoing disruptions brought about by the war. And to make matters worse, now you find that your major international grain traders are now leaving Russia. So Cargill and Viterra, these are your two of the biggest international traders, and they said they would actually halt grain purchases from export from the country. And beyond Cargill and Viterra, Archer Daniel Midlands is also now weighing options to quit its main Russian operations. So government pressure and operational difficulties in the wake of the war have made staying in Russia rather unfeasible for them and for many of these international grain distributors. So the departure of your Cargill and your Viterra, for instance, what it means is that it leaves your Russian grain supplies largely in the hands of your domestic and government-funded companies. So meaning that Russia's grip on the food supply was supposedly tightened, and this will make it easier for Russia to use food exports as a tool of geopolitical influence. And of course, this would naturally heighten your food security concerns. So another reason why we're seeing the rising food prices is that of your trade restrictions as well as protectionism. So the result of this rising and food insecurity fears is that it has actually driven countries to introduce your protectionistic policies that restrict or stop the export of food. So we all know our friendly neighbors, Malaysia, at one point decided to announce a ban of chicken exports to Singapore, and Indonesia at one point of time had limited palm oil sales. And as you can see from the table above, here are just some of the examples of the other type of trade restrictions and protectionism policies that governments around the world has introduced. And of course, this list is non-exhaustive. So much so that even after a full year, after the outbreak of war, the World Bank actually found that there are about 101 separate restrictions that remain on food exports globally. And all of this continue to remain. So naturally, all these food restrictions and food exports, they help to actually push up prices, although they do make it easier for governments to actually feed their own populations. But looking on a global level, these actually push up the prices, and all these heighten your food supply fears. And on the longer term, the supply side is being impacted by many challenges, and the main challenges actually faced is that of climate change, as after all, we're talking about agriculture. And agriculture is highly sensitive to your weather and climate. So much remains unknown about how the world's rapid warming temperatures will actually affect agriculture, economic activity, as well as trade in time to come. But I think one clear trend is that your natural disasters like your droughts, as well as your hurricanes and your wildfires are becoming more frequent and they're unfolding in more locations. So of late, there is no shortage of headwinds impacting your food supply, with heat waves and droughts taking a toll across Europe, China, and India. And as the planet continues to heat up, weather patterns will continue to change, and this will be a growing drag on agriculture output in the years to come. And of course, this goes back to impacting our fragile food supply. So moving on to the demand side, after talking about the supply side earlier, all of this have happened while China has reopened its economy following the removal of its demand-sapping zero-COVID policy. And China is, after all, one of the world's most populated country and the leading food global importer. In fact, over the years, the country's import volumes have been steadily growing. And naturally, this reopening of China's economy looks set to increase the Asian giant's demand for food imports, and consumer demand is set to actually slowly recover as the worst is likely being over for the Chinese economy. And speaking of demand, the consumption of meat is also increasing. And this in part has to do with a growing middle class. So the global middle class is expected to grow to more than half of the world's population by 2030. And this drives the demand for more protein-rich foods such as your meat and your dairy. As increasing disposable incomes, they open up a range of dining opportunities for your consumers. And income growth in developing countries, for instance, will shift your dietary preference towards more protein-heavy foods, for instance. And in particular, you find that Asia's middle class is growing at a much faster rate compared to Western countries, with India and Southeast Asia being guilty as well as being accounting for the greatest increase in food spending. And I think we all know that when it comes to meat production as a whole is very and highly inefficient. So I just give an example. It takes about 7 kilos of grain to actually produce 1 kilogram of meat. So it sums up how inefficient meat production actually is. And last but not least, on a longer term horizon, the demand for food is only set to grow. And of course, one of the most compelling trends underpinning the industry's growth is the rising global population. And this is expected to reach about 9.7 billion by 2050. And this makes there a pressing need to actually figure out how to increase our food supply. And just in Asia itself, it will take about 1.5 trillion in investment to keep up with Asia's growing demand for food over the start of the next decade. So there's definitely no question that food security is one of the biggest problems facing the world today. And so with this thought, we would naturally think that more attention should be paid to that of the agribusiness sector. And no doubt, increasingly, investors are more aware, and this sector as a whole is actually gaining more attention. So looking at the agribusiness industry would actually involve us looking at the industry's value chain. And the agribusiness value chain, it spans across the entire spectrum of businesses related to your food production. And in essence, it describes all the activities relating to the different phases of production, from your procurement of raw materials to that of the retailing of the end product to that of the consumer. And increasingly, we're seeing more companies within the agribusiness industry employing more technological tools to actually increase productivity in order to meet the growing demand. And this whole incorporating of technology and farming is known none other than precision farming. So in essence, it involves the use of technology to enable farmers to actually optimize their crop productivity. And precision farming is not just important because it increases efficiency, but it also allows for more sustainable farming practices. And of course, this would greatly help to reduce waste. So one example in which precision farming can actually be used is to apply your herbicides using cameras that enable the targeted spraying of these herbicides to weeds in a growing crop area. In fact, without broadcasting these herbicides across an entire field of crops. And you can see that this process can actually be done on a large scale. And of course, it really helps to reduce the amount of inputs being used. And of course, it's more efficient at the same time. Besides that, drones can also be used for the precision farming tools, as they provide tools for mapping and imaging, and they provide vital information about plant health throughout the field. And the use of drones in the application of your chemicals, such as your pesticides, is another application of such technology. So besides, we are trying to advance towards a autonomous future in which artificial intelligence, or your AI, in addition to your robotics as well as autonomous vehicles, can all be used to help create greater productivity with fewer workers and more careful use of resources. And of course, agriculture will not be left behind in this process. And Deere & Co, for instance, one of the companies, they have come up with driverless tractors. They are equipped with many cameras to provide views of the farm or the crop views. And in the sense that the self-driving tractor can be controlled with the farmer's smartphone. And once being placed on the field, it enters operation and allows the farmers to focus on other tasks without the need for additional labor. So these are just some simple examples of the innovations that exist within the all-important agribusiness industry. And we think that the industry presents an area of opportunity. And from a portfolio perspective, we believe an allocation to the sector could actually provide some form of benefit. And with food prices remaining at elevated levels, companies that support your food production would benefit, as rising prices lead to increased production. And consequently, this higher production translates to an increase in spending on your seeds, your fertilizers, your farm machinery, and benefit companies higher up the agribusiness supply chain. And more importantly, the industry is viewed as a long-term investment theme, and it stems from your world population growth, and with it, the growing demand for food and agriculture products. So with this in mind, investors can actually gain exposure to the agribusiness opportunities via this VanEck Agribusiness ETF or your MOO ETF. So here are the top 10 holdings of the ETF. And you can see that these are companies that are involved in the agribusiness space and would serve as important players in time to come. So from today's presentation, I hope to perhaps to have piqued your interest with regards to this all-important agribusiness sector and its opportunities in time to come. So once again, I'd like to thank you for your kind attention, and I hope you have gained something new from this presentation. Thank you.
Okay, thanks everyone for still staying till now. And we're a bit behind schedule, but there's something exciting after this, which is the lucky draw. And in true iFast style, we'll keep it I for interesting and fast as well for you. So I'll start. I think you heard quite a lot about Singapore equities, Singapore REITs, outlook for China. I think a lot of these matters are ultimately still linked to the outlook in the US. I think in the last few days, we heard about the US regional banks correcting quite severely, but last night they start to chong again. So, I mean, it's basically just quite volatile. I think Paul from Nico, your speaker, Eugene, was talking about the VUCA environment. So maybe the first question goes to you, Paul. You know, with all these expectations about interest rates, some people say it's peaked, it's going to come down. Some people say it's going to stay that level for a long time. What is your kind of outlook, and how does it affect, let's say, for Singaporean investors who are into Singapore bonds?
I think clearly the outlook is still pretty volatile there. But I think one thing is pretty consensus by now is that the Fed is unlikely to be as hawkish in terms of raising rates anymore. And we are talking about potential scenario of actually rate cuts somewhere down the line. And look at our portfolio of ETFs. We do have two very safe bond ETFs here in the Singapore market. My colleague Eugene has talked about them in quite great detail. The ABF, which is a Singapore government bond, as well as the IG, the high grade investment grade corporate bond, which are two Sing dollar denominated ETFs. I think the strength of the Sing dollar is one quite attractive factor there. And the quality of the Singapore government and the Singapore issuers, this should be quite reassuring for investors looking to tide through this period of uncertainty, right? Yeah.
Okay. And I'll throw one more question maybe related to the fixed D rates, because we got that from our investors as well. But I'll move on to Colin. Colin from UOB AM, not our iFast Colin. I have two Collins in the panel. So Colin, I think in your presentation you talked about the US-China technology war. I think a lot of our investors here will agree that maybe it's not just a tech war, it's a It's a war in ideologies, in thinking, and it's going to go on for quite a long time. But recently, interestingly, China and the BRIC countries and Saudi Arabia and all that are like all very friendly and chummy and saying that we have to cooperate closer. We should use our own currencies to trade, things like that. So I think this question also came from one of our investors when I was talking to him. What do you think will be the outlook? You talk about China and Chinex, right? So what would be the outlook in terms of currency for Chinese yuan and the USD?
Thanks. I would say that by 2030, China is very highly likely to be the largest economy in the world by GDP. If you add up, given that US is probably growing just 1 to 3%, or China is likely to grow from 3 to 6%, for example, there'll come a point, and this point will be like 2030. So, in that sense, I think the Chinese economy by then, should be, at least, in GDP terms, larger than the US. But however, as we all know, US still has the largest military force in the world. And it will be because the fact is that they spend, at least $800 billion a year. While China only spending close to 270 billion a year. It's still a lot of difference. And not only that, the US military force, will be also a factor when you consider, your currency strength. And of course, you all know that US dollar is the reserve currency in the world. By far, it's still around 57% of all, sovereign funds, sovereign wealth, as a percentage of reserve. And China is still very small, but, because of the war, and because we know that, US has imposed what you term as sanctions, or freezing your US dollar account. So a lot of countries also do not want to avoid that. And secondly is that, US print a lot of money. It's a fact, okay? I'm just stating the fact. US print a lot of money, and that actually gives rise to inflation. And when inflation comes, in US having 6-7% inflation, the rest of the world also affected. And when US raise interest rates, the rest of the world will also negatively affected. So when, for example, Sri Lanka went to bankruptcy, they need IMF help. And IMF help is basically headed by US, and they want them to implement austerity drive. Oh, that's why Anwar, Prime Minister Anwar from Malaysia, went to talk with Xi Jinping to talk about Asia, Asia Monetary Fund, AMF. But I believe that over time, as globally as governments reduce exposure to US dollar and increase a bit of exposure towards Chinese yuan, I think yuan will be stable. I think gold, on the other hand, will also be one of the alternative resource that's governments will also want to invest in gold. Yeah. So, not exact. I mean, you can't entirely replace US even for the next 10 years, but at least, shifting more exposure towards Chinese yuan, towards gold.
Yeah. Yeah, it's an interesting point that you brought up, Colin, about gold as well. So maybe since we're on gold, I'll get Jermaine from State Street that I'm sure he will have a couple of opinions on that. So what's the outlook for, for gold? Because some of our clients also have been investing a bit more this year in gold ETF.
Yeah, we're pretty positive on gold at the moment. Gold prices tend to be very positively correlated with inflation. So in periods of high inflation, gold prices tend to go up. What has happened in the past couple of years is that we have been in a sustained period of high inflation. However, we have also been in a period of rising interest rates. So rising interest rates is not good for gold, right? Inflation is So both sides kind of contradict each other, and we are where we are right now in gold price at about 2,000. Now going forward, we think that the rising interest rate environment is over. Probably interest rates will not go up any further, stabilize a while, and may even come down. That's going to be really good for gold. Yet, we don't foresee inflation coming off. We think that inflation will continue for the time being. So with these factors, we are actually very positive on gold for the second half of 2023.
Yeah, thanks, Chairman. I'll go to Adrian from CSOP. So as REITs, Singapore REITs are a very popular investment product, I think, for a lot of investors in Singapore. So, the outlook for CSOP, the outlook for S-REITs, in a way, hinges on the outlook for interest rates. I think if you expect interest rates to start coming down quite soon, I think that's relatively good news. So what's your expectation, Adrian?
Yes, I just want to echo what Jermaine did mention about like how gold and REITs as a whole is a very good hedge against inflation. Just to add on to Jermaine is that REITs, not only good hedge against inflation, but REITs and Singapore REITs as a whole still, distribute income as dividends. As our local tax regulators did mention that 90% of the income of REITs has to be distributed to unit shareholders. And by law, by that tax kind of regime, we stand to benefit from any rental income. Up to 90% of those collected by REITs managers has to be distributed to investors like us. So I think with that, just to echo what Jermaine mentioned, we also expect the interest rates to probably take a pause. And with that pause, it will be good for gold. It will be even better for REITs, especially Singapore REITs, as for local investors. That's our take for Singapore REITs going forward.
Yeah, thanks, Adrian. So I'll go to our IFAS, Colin, because we have a question from an investor, which is because I think Wei-Ren from our IFAS research team was talking about our positive view on Japanese equities, right? So the past decade of poor inflation has led to Japanese companies to invest out of Japan. Will the strong yen put a shackle on their earnings instead? So maybe just a quick take on that.
All right, I think that's a great question. In fact, it's one of the primary concerns for many investors. So our view is that no, it will not. For this couple of reasons. Firstly, we think that a higher yen can quell a lot of macro risks, such as trade deficits, such as higher imported inflation. So those are wreaking havoc on the P&L of many Japanese companies. The second reason is higher yen could in fact draw back in flows from foreign investors. Because if you look at pre-COVID, there is a lot of outflow from foreign investors as yen kind of plunged. So if you look at where yen is going right now and the strengthening of the yen, and we look at the inflow of funds into Japanese assets, they are in fact increasing right now. So that is the second reason. And the third reason is that we do believe that for foreign investors, the increase in yen could bring about currency gains, additional currency gains, and that is important to add an additional layer of buffer for your returns when it comes to investing in Japanese yen. So for these three reasons, we do think that the upside for the positivity that comes with yen appreciation definitely outweighs the negativity. And the last point is that where yen is right now and was a couple months back, they are at an extremely low level. So the appreciation comes from a very low level, and so it's from a very low level higher, and not as compared to a historically average level higher. So the impact will be different. The starting point matters. So for all these reasons, we do think that yen strengthening would in fact have some positivity.
Yep. Okay, thanks, Colin. I'll go back to Paul. So I think just now I was alluding to the next question from our investors. So they talk about deposit rates in Singapore around 4% or close to 4%. So is it still worthwhile to invest in bonds? What do you have to say?
Well, if you look at the fixed deposit rates, and I think a lot of you also have an interest in T-bills. Obviously, there's a lot of interest there, which we never had in the past. Since when, I can't imagine a time where fixed deposit rates was 4%, T-bills almost 4%. So obviously, if you look at some of the bond ETFs, you'll be thinking, hey, 3% government bond versus 4% T-bills. But I think ultimately, if you think about it, they are actually all very safe assets, and they can actually work complementary to each other. They come in different packaging, if I could put it that way. So one thing good about buying ETFs is that unlike fixed deposits or T-bills where there is a duration lockup, for example, 6 months, 12 months, whether is it fixed D or T-bills, ETFs traded on the exchange gives you liquidity daily. All right, so you can come in and come out with ease of access, and that is one of the benefits of actually buying the fixed income ETFs that we have. Yeah.
Yep. Thanks, Paul. I hope that helps with our client's question. So I'll go back to Colin from UOB AM. I think you were making a strong case, basically the positive structural factors for China, right? Population and healthcare. You also mentioned about EV and solar. But what scenario do you think will change your mind on China's attractiveness? What could be something that you will keep a close eye on that could change your view, and that maybe all of us should as well?
Sure. Thanks for the question. I think the key is basically monitor the development for what we term as advanced chips, advanced semiconductor chips, which is defined as something as anything 5 nanometer and below. And that's where China at this moment are unable to produce in China. And US is trying to prevent China for developing it. The key point here is that 5 nanometer or advanced chips actually will be used in quantum computing, in going to 6G. And I'm sure, I don't know whether you have traveled to China. China have actually started their autonomous driving. That means no driver, driverless driving already. And, they need to have 6G. And 6G probably needs advanced chips as well. And, quantum computing, AI, for example. And therefore, with China just doing at 7 nanometer, they had to have this breakthrough. You may take years, but the point here I want to highlight is that if all you follow is that I think over the last few years, China has made actually fairly significant development. If you are aware of the Beidou navigation system, which is just launched during the COVID period, this is your equivalent of your US GPS. If China is so lack of technology, they were not able to produce that. And China is now, having their Tiankong-based space station. When IIS, the International Space Station, going to decommission in a year's time, then China Tiankong space station will be the only space station, in the world. And if China is so low tech, then China can't do that, you see. And China is now aspiring to be on the other side. They call it the other side of the moon, which actually US never had tried even before. And now US is trying to go to the moon again. You saw a bit of failures, in terms of launching their aircraft, their space stations. So basically, I'm going to highlight to everyone is that yes, we have years over the last 30, 40 years understand that US is very dominant in technology, especially in software. But China is emerging, and at this moment, trying to suppress the emergence. The fact is that if China has the talent, by the way, a lot of so-called Chinese, who went, Chinese scientists who went to study in US, stay in US, work in US, actually coming back to China. And with talent, by the way, they have 1.4 billion people. It's not like in Singapore, only a few million people. There are 1.4 billion people, enough talent, sufficient, enough capital. So it just need the push ahead. I felt that the Chinese government right now and the Chinese people are very driven to push this ahead. And I think with time, they can overcome this and able to produce and able to so-called, overcome this so-called suppression.
Yeah.
Thanks.
Yeah, I think the China debate and the outlook, especially its competition with US, we can talk a lot. So follow us for more insights, and also of course as we interview some of our fund managers as well. So I'll move closer to home, Singapore. I'll go to Jamin because she spoke about Singapore, right? But a lot of I think the topic was focused on dividends and so on. But are there some interesting growth stories coming out from Singapore? It's not just dividend and stable income, right?
Well, I think there are pockets of opportunities for growth. I shared earlier. There's Sealim and Grab, but they're not listed. They're not listed on the SGX. Well, predominantly, we really still see the STI as somewhat dividend related index, and we think that the dividend is going to continue to grow from here, which kind of makes sense with where interest rates are as well. There needs to be a risk premium for investing in equities, especially for the REITs. We do expect the yield to go up further. So I think JP, that's what I will have to say and have to share on that.
Yeah. Okay. Thanks for that. We'll maybe take one more, a couple more questions. So I think for Adrian, as REITs, you have your different sectors, right? So which one is the one that you are most positive on, and why?
Yes, so REITs market as a whole in Singapore covers many sectors like data center, industrial, retail, office, hospitality, and multi-asset. Now, each of these asset classes, each of these sectors, perform differently during different market situation. And when we launched our first S-REITs ETF in November in 2021, we were brainstorming in how do we have an ETF that covers all the different sectors and give investors dividend yield and the capital appreciation for all the S-REITs. But right now we first in my lifetime, that we face a pandemic, and like what Jamin said, every sector has a bright spot, a period to shine in different market situation. And we found that there is a special ingredient in our ETF is that during COVID, the industrials, the data centers were doing very well because we're all working from home. No one is going to office or shopping online. So we have a mechanism which is a unique selling point, is that we rebalance our sectors based on liquidity. And rebalance every 6 months, looking through the liquidity of different REITs. Now, what does it mean is actually we are looking at the institutional flows, the smart money flows to the different sector. A very good classic example is in September in 2021 when Singapore government says we're going to relax from 5 a table to 10 a table. We saw a lot of flows going to Suntec REITs. And that's where we balance into the exposure of our ETF into Suntec. We increase the weight. On the flip side, we saw there's not much flows into US Manulife REITs as well. And from there, we also took profit. And when we pare down our weighting in terms of the Manulife from about 2% to less than 1% weight. And true enough, you could see that Manulife has actually gone through a bit of crisis right now. Yield has gone up, but if you have taken up the yield, you're probably sitting on a huge capital appreciation kind of loss, capital depreciation. So what I'm trying to say is that right now, the market likes, the investors likes the industrial, likes the retail, and likes the office right now, and that is where the big, huge sectors that our ETF and index is actually heavily weighted. Hospitality, we saw, we were still very positive, but right now, till the tourists come back, hospitality still is a bit of underweight in terms of our ETF. Yep.
Thank you. Okay, I don't want to hold the audience up for too long because there's something exciting afterwards. But maybe just to wrap up, 1 minute solo performance from my BTS panel, starting with Paul. What's the key takeaway for our investors today?
I think one thing good about ETFs is diversification. And in uncertain times going forward, there's benefits for actually investing into ETFs because we don't know where the markets are heading right now. And the one thing that Nikko Asset Management have is that we do have quite a good selection of ETFs in Singapore, 3 fixed income ETFs, 3 equity ETFs, and we also have the Singapore government bond, which is the only AAA government issuer in Asia. So thank you very much.
Okay, Colin?
I think I'll give something more along the lines of markets. So even if times are hard, market is uncertain, market is volatile, but there are still opportunities. I think if you were to look beyond the asset class, look across asset class, from equities to bonds to even other asset class, you will find opportunities. But as long as you do your homework, look at the risk, I think there are still fine opportunities out there.
Okay, Adrian?
Yes. So, like I did mention, diversification is very important, and there is an ETF right out there that diversify into different kind of sectors based on the market situation. You can definitely consider our CSOP IH as leaders ETF. Thank you.
German.
It's the same thing I say all the time. I think markets have been quite uncertain and quite volatile this couple of years, but the market has always shown us that it's not about timing the market, it's always about time in the market. So stay optimistic, stay invested.
Colin?
Yep. Finally, I just want to highlight to everyone is that invest for the future. And in this case is that invest in technology, that you're going to see fairly strong growth over the next 5-10 years. I highlighted during my presentation, we talked about EVs, electric vehicle. We have a fund, a Chinex ETF where, basically takes on a lot of high-tech industries, and most of them are actually EVs. Like, for example, CATL is one of the key holdings in the fund, in the ETF. Why I say that is because, over the next 10 years, our combustion engine cars will be out of phase, just like our old Nokia feature phones. We're all going to use EVs, and it's going to be very competitive. But in the automaker space, a lot of competition. But in the EV battery space, there are actually not many competition against China. The fact is that the Western, you don't hear of any EV battery maker from Europe or US. They are all so far behind, and they will take at least 10 years to catch up the Chinese EV battery makers. Thanks.
Thank you, Colin. Hopefully that was smooth as butter for my BTS crowd. So thank you. One round of applause for my panelists, please. And I do know that a number of you have more questions that we have received. What we'll try to do is to answer them and put up as a Q&A article on our website. So keep a lookout for that. So thank you, and good luck for the next lucky draw. Yep. All right. So